And I think what the Fed is doing in terms of its guidance as well as its accommodative policy is going to be a positive as well. But we have a few real obstacles over the next year. I mean, one is that inflation is continuing to fall. And one of the numbers we think we're going to see today is a flat core PCE number for the month of November, 1.3 on a year ago basis. Service prices in particular have gotten hurt and are really, in our mind, quite inertial. They don't move very much once they've been shocked. So we think that you're going to get strong growth helping you, but the balance of forces here, I think, is going to continue to be low inflation, at least for another year, year and a half here.
But it's a real theme here. I mean, the vector of inflation expectations, Bruce Kasman, is arguably my chart of the year. I've been so busy with Washington, and I haven't come up with a chart yet. But Bruce, the trajectory of inflation expectations, what derails that?
Well, let's just put inflation expectations in perspective. It's moved up importantly over the last few months, and I think part of that is on the prospects for growth, and part of it is on the Fed. But inflation expectations in the U.S. is still low. Inflation expectations outside the U.S. in key places, the Euro area, Japan, are ridiculously low. So, you know, what we've gotten here is, I think, some change, but we still don't have an environment that supports the Fed's objective that gets us an inflation overshoot anytime soon.
Yeah, this is really important, folks. We'll deal with Anthony Crescenzi of PIMCO with this here in a bit. Amazing to see the deflation expectations of, say, Switzerland. Bruce Kasman on China, the JP Morgan call.
Well, China's had an amazing run here. It looks to us to be completing a V-shaped recovery as we move to the end of the year. I don't see any reason why it's going to not continue to benefit if we get a vaccine and strong growth globally. But the interesting thing about China is success is going to allow them to take their feet off the gas. And we do see a significant tightening in credit and fiscal policy next year. And China kind of moves back from being the leader of the global growth story. And that's going to hurt commodity prices, we think.
Well, then is it time to move out of EM? I mean, I don't want you to play equity guy here, Bruce, but that's quite a statement that commodities lose the oomph. And does that mean the great international EM play loses the oomph?
Not, I think, in the next few months, because I think the China story is one that plays out over the first half of the year. But I do think as we move through the year, you've got problems in a number of big EM economies. China's not going to be the engine. I think where growth is going to kick in next year is in the U.S. and Western Europe, assuming the vaccines work, assuming that we contain the current second wave early enough and get the U.S. fiscal stimulus.
Bruce Kasman of JP Morgan, please stick with us. We want to look ahead to the employment picture and the pain that we're seeing in certain spots. Coming up, Stephen Hahn, FDA Commissioner. That's at 8:30 a.m. in New York, 1:30 p.m. in London. From New York, Lisa Abramowitz and Tom Keene, this is Bloomberg.
Merry Christmas. Do you want to take my 30-day challenge? See if you can manage one set.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
This is Bloomberg Surveillance. I'm Rishka Gupta with your Bloomberg Business Flash. Bloomberg's learned that Pfizer is close to a deal to supply more vaccine doses to the U.S. government. The agreement could result in the government getting up to 100 million more doses. There have been reports that the U.S. declined an offer earlier this year to buy more of the shots. Elon Musk says that years ago, Apple CEO Tim Cook refused to take a meeting to discuss buying Tesla. Musk indicated the price would have been about $60 billion, roughly 1/10 of its current value. Musk says he reached out to Apple in what he called the darkest days of the development of the Tesla Model 3. Apple's not commenting. And movie theater operator Cinemark is suing its insurer for refusing to cover $400 million in losses and legal expenses. The money is linked to the coronavirus pandemic. The third biggest U.S. theater chain says Factory Mutual Insurance failed to honor Cinemark's policy. The movie theater business has been devastated by the pandemic. Factory Mutual isn't commenting. And Volkswagen CEO Herbert Diess warns that cash-rich tech giants pose a bigger challenge to the German car maker than traditional rivals like Toyota. Diess was reacting to a report that Apple is developing a self-driving car. He says that practically unlimited access to resources instills a lot of respect. And that's the Bloomberg Business Flash. Lisa?
Ritika, thank you so much. A turn to markets turning up as you see the Russell 2000 continuing to outperform. But what I was watching is that it's actually coming off earlier highs a little bit, Tom. Basically risk on despite the turmoil we're seeing in Washington.
I'm looking at an entry point here, and I'm still looking, folks. It's
Quintuple leverage cash.
yeah, we're looking quintuple. We're not there yet, but we could go quintuple leverage all cash. I mean, look at the yield there. And actually, that's a serious issue, folks, when you look at the debate in the next year of negative yields in Germany over the last 2 days. Negative yields a little lesser negative as well. The ebb comes off there. And as Lisa mentioned earlier, the real yield, the benchmark here, negative 1.0371 in the U.S. And the equity markets where the story is today, the VIX 23.40. And just a nice sustained lift to equities. I'm not sure where that's going to be at 10:30. Or for that matter, 12 noon, but it's got that holiday feel.
12:06 p.m.
Except, Lisa, there's a little bit of economic data at 8:30.
Yeah, and the question I have is how are people going to read it? If it's really negative, does that mean that people are going to price in a bigger stimulus, or does that just mean, bad news?
Yeah. Well, it will be interesting as well. In New York City, it is the most important interview. Patrick Foy, we love speaking to the gentleman from the MTA. He has had an interesting 2020. Bruce Kasman's still with us. Stay with us. This is Bloomberg.
a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel. This is Bloomberg Surveillance live from New York. I'm Lisa Abramowitz alongside Tom Keene. Francine Lacroix is off.
She's doing her Christmas shopping. We're not.
Christmas, yeah, that's right. You're still, you're going to do that tomorrow, right, Tom? You're going to go.
12 noon.
Yep, we're going to be looking for you, trolling the stores. You'll be the only person there. Which talks about the two-tier economy, which brings us to this concept of this widening divergence between the haves and the have-nots, and the haves have more after this year, and the have-nots don't have. And there's a question of what the post-pandemic economy will look like, what this gap will look like, and whether there will be enough jobs to fill some of the lower income roles when we emerge. Still with us, Bruce Kasman, JP Morgan chief economist and head of global economic research. There is a question, Bruce, of what full employment looks like post-pandemic. What's your take?
Well, I think the first and most important point is that even with strong growth next year, we think we're going to end next year still something like 3.5 to 4 million jobs light of where we were coming into it. Then you have the issue that there's an enormous amount of dislocation across sectors, particularly in a lot of the services that have gotten hurt, that's not going to come back. And that's also hitting us in terms of the small and medium-sized businesses relative to large. So I think what's really an important issue here is this is an event that we're going to get strong growth coming out of next year with the stimulus, with the vaccine. But we're not going to heal very quickly. There's going to be a lot of imbalances. The labor market's not going to look as bad as after the global financial crisis, but it's going to be damaged. There's going to be scarring. Older people like myself are probably leaving the workforce early. Nothing personal there. Women and minorities are hurt particularly badly. It's going to be a difficult time to heal the labor market in the U.S., and it's going to be with us for a long time to calm the damage from this event.
Bruce, this is so important. People talk about the strong growth in the economy, but strong growth for who? It's not for everyone. You talk about the big companies getting bigger. Can you paint a picture of the consequences of this increasing dominance of the behemoths and the absolute decimation of a lot of small businesses across the country?
Well, I think there's a lot of things here we can see, one of which being it's going to be a drag on growth. I think it's always the case that the weaker links are what determine how strong you grow. There's going to be issues around aftershocks here, particularly in credit space. In the U.S., we're not particularly worried about an acute problem, but we do think the drag from small and medium-sized companies is going to be with us for a while to come. There are probably more important pressure points there outside the U.S. to worry about over the next couple of years. And then I think the social and political pressures that build. We saw the last decade after the GFC a number of things which may have not been obvious to predict that came up as a result of the imbalances, pressure points, political upheaval. Those are things which are definitely going to be consequences of this event for quite a while to come.
Bruce, I got a 2-hour interview going here, but I've only got like one more question. So I'm going to try to frame it in as the pandemic partition and overlay it with JP Morgan's brilliant call on a lower potential GDP. This nation is used to 3.8% growth, 2.8% growth, whatever. We're nowhere near there. How do we adjust to a lower run rate?
Well, I think the point is it's painful, and that's part of the issue here. We think potential growth in the U.S. is about 1.5%. We haven't made any changes as a result of the pandemic. We're worried that we could go down off of this, although I am cognizant of the fact that crises don't always cause bad things on the supply side. There is some opportunity for better things to happen here. But we are worried that we're going to lose workers, that we're going to dislocate the economy in a way that's going to create negative dynamics here. And again, I think part of the problem is that the pie grows more slowly. It's a lot harder to deal with imbalances, and the political, economic, and the financial market implications of that are a real potential threat here, even in a year where we're going to get very strong growth in 2021, we believe.
Is Mitch McConnell and the conservative crew, are they correct that we don't have the growth to get ourselves out of this debt?
I don't think that's quite true. I think the point is that we need to take on debt to make it through this event, but that is going to cause some set of problems And, how we manage it from a policy point of view will determine whether those problems are modest in terms of their drag or become more serious. Easy money is giving us the opportunity to allow fiscal to provide that space here to heal. The question is how much and how effective is that policy mix.
Dr. Kasman, thank you so much. This has been hugely beneficial. An interesting morning of economic data here for JP Morgan, and all of us will have that at 8:30 this morning. Futures up 12, now up 9. With our news in New York City, here's Ritika Gupta.
Thanks, John. President Trump is complicating the outlook for the coronavirus stimulus bill passed by Congress. He's signaling he may not sign it and is demanding changes. One of them, increasing the size of the checks going to most Americans from $600 to $2,000. The president calls the bill a disgrace and says it's full of wasteful and unnecessary items. Meanwhile, Joe Biden warned that the darkest days of the coronavirus pandemic were still to come. The president-elect called on Congress to be ready to produce another stimulus package early next year, but he's not putting a dollar figure on it. President Trump's trade czar is leaving next month, hailing the tariffs that his critics hate. Robert Lighthizer rejects the consensus from economists that the duties on imports from China and steel from around the world have been a failure. He says that in 5 of the 6 quarters before the pandemic, there was a decrease in the U.S. trade deficit. Plus, Lighthizer says the tariffs helped lead to higher household income. And a post-Brexit trade deal hangs in the balance, with fishing rights still the key issue. Prime Minister Boris Johnson and European Commission President Ursula von der Leyen have intervened. They're making a last-ditch bid to reach an agreement before the UK leaves the single market at the end of the year. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Thank you so much, Ritika. Coming up next, Tony Crescenzi, PIMCO market strategist and portfolio manager, on the big raging debate heading into 2021 on inflation. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here? It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Bloomberg.
Bloomberg Bloomberg Savannah's good morning, everyone. Lisa Bramwitz and Tom Keene focused on Washington and upper there. If you're waking up last night, the president truly making history, blowing up any discussions of a smooth path to stimulus. We'll have much more on that today, particularly balance of power here at 12 noon. How about a single best chart now? I got to figure out what my chart of the year is. It's the latest I've ever done it. Usually I have it in July, and I keep it secret, state secret till September.
We all know.
How about inflation expectations? 3% normal way back when. Down we go with a pandemic spike down, and boy, we come back. But it puts it in perspective there. You wonder where we'll be in 5 years. Bruce Kasman of J.P. Morgan just suggesting lesser inflation here in the foreseeable future. Right now joining us is Anthony Cosenzi. You may not know him, but if you've been watching Pandemic Financial TV, you do know him. Here's the game. If you're in economics and you have books behind you at your house, you have to have Piketty's Capital. It's a big, thick yellow book, and nobody's read it, but everybody has Piketty behind them because they're smart. If you're in fixed income, you have Tony Cosenzi's book behind you, Steigum's, which is a 1,200-page classic. Nobody's ever read it, Tony, but they've got to have your book behind them.
Students have.
Students read it, but nobody has it on Pandemic TV. If you were writing Steigum's today, the 5th edition or whatever it's going to be, Tony, what would you say about the short-term market that you own with that book?
Well, I wrote a new book, and it'll be out in stores, so to speak. And Tom, your name is in it. I give you credit for all the great work you do. I've written a new book, and one of the key emphases I put was on negative interest rates. I never thought there would be a reason to talk about negative interest rates, and as we know, we are. And that's a short-term interest rate. And so I have an entire chapter devoted to
Very
that.
Cool.
Never mind what I think.
This is really important, folks. We're really looking forward to that. That may be my book of the year 18 months out. Tony, that's great. So we've got negative interest rates. To that chart I just showed, then is there a new normal out 5 years on the run rate of inflation?
We'll make the bet that, yes, it's the Federal Reserve, central banks globally will be successful in pushing the inflation rates upward. The Fed, August 27th of this year, gave a new framework. It's a one-page document on its longer-term goals and its monetary policy strategy. And it said, for example, that the goal of maximum employment is one that's broad and inclusive. It codified the idea that it wants to do more for the economy than simply bring the unemployment rate down and make it doesn't want it to just be a number. It wants to know that people are benefiting in ways they never thought before. So that being codified, and now with the incoming administration focused on creating a broad and inclusive gain in employment, it's more likely that that will happen, because we know the Fed won't do what it did in the early 2010s, which was to prematurely raise interest rates and to it failed to signal that it would refrain from raising interest rates if the inflation rates start to pick up. This time it will let it go. So it probably will pick up, but it won't pick up meaningfully. It just will pick up probably toward its goal of 2%.
Tony, when we talk about inflation, we speak about it as though it's a monolith, and yet we know that healthcare inflation, rent inflation until this year anyway, college education until this year had way outpaced other types of inflation. Are we measuring inflation right?
It's a basket of goods, so maybe not. And it's just part of the story, some people think, behind Bitcoin. There are other types of inflation that don't necessarily benefit society. We'd like to see the type of inflation that benefit people through their wage increases, but that's not been happening. It's difficult to say. The Boskin Committee, as it was called in the 1990s, sought to determine under President Clinton whether the inflation calculation was correct. And lo and behold, when budget deficits were high and they wanted to get it down, and we ultimately had a surplus, they found a new way of calculating it, and poof, 1 percentage point was shaved off the CPI. So policymakers will always look to keep it down.
I mean, Lisa, come on. It's a drinking game, and Cosenzi just fell for it. He mentioned the dreaded B word, so we got to go there, don't we?
Yeah, of course. Why don't you take
Anthony
it there,
Cosenzi on Bitcoin. In your new book with negative rates, do you have a chapter on Bitcoin?
Well, there's a few words to say. Well, central banks, one reason the Fed is deciding against the negative interest rates because it's costly to banks. It costs 3 basis points per month for a bank to have more physical cash to give to us out of ATMs. Why? Because for whatever reason, it costs money to have it shipped and stored. And that's the 35 basis point cost just from moving to negative rates. Because if there's a negative rate, all of us individuals will say, well, I want my money out of the bank. I don't want to get charged for keeping it there. Give me cash. And that's costly. And there are numerous other factors. With Bitcoin, theoretically, the Fed could shift to a minus 200, 300, 400 basis points because there is no physical arbitrage. Putting that aside, let's keep in mind Bitcoin is not money. It's a form of exchange, and there's 3 ways of exchanging money. One is physical. Of course, we have cash and coins. Second is electronic through a trusted third party like the Fed. When we send money through an ATM or some other electronic means, it's through a trusted source. And third, it's the other electronic source, which is Bitcoin. It has no trusted source, and that's where it gets a little dicey because it's one thing to see volatility in a currency, but it's totally another to see volatility in the exchange mechanism, the way that people are paying for things. And so at some point, regulation will come along, but if you're investing in Bitcoin in part, you're investing in the technology, which is a totally different story, and I can't opine on that, but it does look like Bitcoin is the winner in this game of electronic money, digital money.
Tony, this seems fascinating. I know you're not making a call and you don't want to make a call on Bitcoin. However, you are giving it credence as an alternative or some sort of digital store of money, the digital gold. And my question is, are we going to get a mass debasement of fiat currencies in the wake of the money printing as well as some of the negative yields, this idea that people need a store of actual cash that's somewhere away from these monetary authorities?
Bitcoin, as I said, without a trusted source, not having the hegemony, the leadership of the potency of the United States, politically, economically, and militarily to protect the value of money is important. Bitcoin lacks all of that, doesn't have the full faith and credit of the giant and massive and potent U.S. government behind it. So when we say fiat currencies, we might be pointing to some, but remember, Bitcoin itself is fiat, and so one has to be careful about that. But there is a notion about Bitcoin that is similar to gold, of course. One could move into it because they decide certain currencies is not worthy anymore, and then, of course, move into some other currency eventually. It's sort of like a bridge. And so in that sense, it has a store value element like gold, and it's one of the appeals that certainly the proponents are pushing.
You've worked at the New York Fed. You have a lot of experience. Just in general, do you think that the Federal Reserve will push for some sort of digitization of the U.S. currency in order to avoid some of the frictions has been discussed?
Central banks seem to be moving in that direction. China is probably the most far ahead. Europe is ahead of the United States. So the U.S. timeline, at least with the current regime, looks like it's at least 5 years out. But the world is moving in that direction, and this Federal Reserve will have to keep looking at it. And as you know, they take a long time to do things. It took them near a year and a half to 2 years to develop a new one-page document, new framework that simply said, we're going to let inflation run.
Tony Crescenzi, thank you so much for being with us. Tony Crescenzi, PIMCO market strategist and portfolio manager. Up next, Lauren Sauer, Johns Hopkins Associate Professor of Emergency Medicine, talking about the pandemic, the vaccine, and the new strain that's leading to turmoil in Europe. This is Bloomberg.
changed as a leader since that day in 1993 when you joined Roche?
You develop over time, and it's a series of experiences which hopefully make you a better leader.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance live from New York. I'm Lisa Abramowitz. I can get my name out. It is Wednesday on the holiday weekend. Tom Keene here as well. Francine Lacroix is off. There is a question as we talk about the virus. We've been talking about the new COVID strain over in the United Kingdom. We have lost track of the vaccination process, which has been ongoing around the world. Joining us now to talk about how it's been going and what has to happen going forward, Lauren Sauer, Johns Hopkins Assistant Professor of Emergency Medicine. Lauren, can you just give us a sense, an update of how the vaccination process has been deployed so far?
Yeah, I think spotty is a good word for how it's been deployed so far. So we're tracking both how many vaccines are going out to states, but also how many vaccines are going into people's arms. And I think given the supply chain challenges and the distribution challenges and the fact that each state is sort of determining the process on their own, we are seeing different levels of success across the country and across the globe. And I think one of the keys is going to be, as we get more vaccine online and into the hands of vaccinators, continuing to send that message that this is safe, this is effective, you want it, you should get it, and that we can do this successfully. That'll be key.
When you talk about the different levels of success and the supply chain disruptions, I'm wondering if you think we're still on track to have the normal public start to get vaccinated in the United States, starting perhaps as early as March, April.
Yeah, I think somewhere in late Q1, early Q2, we'll start to see the public get vaccinated routinely. I think the focus really on the supply chain is going to be ramping up not just production, but all those pieces that you need to get the vaccine safely into the hands of people who can give it to people, right? So the dry ice, the freezers, all the cold chain storage issues, the glass vials, even things like gloves and masks, we're going to need to keep an eye on to make sure that all those steps can be done safely. So, making it safely, moving it safely, and then distributing it and giving it safely.
What's this going to look like? Are people going to call up their doctor's offices and go there? Will it be at CVS's and Rite Aids? How will it be deployed?
I think we're sort of all waiting to see how it will be deployed. I think we're going to learn a lot based on how it's deployed in the healthcare setting and in long-term care facilities, which is basically what's happening right now. I imagine that at some point, yes, we will see this start to look like the way the vaccine is given for a flu shot. It might model some of the testing strategies, right? So you drive up, you set your appointment, you drive up and you get your vaccine. A lot of it is going to be focused around education and need. So making sure that you can safely, while we still have all this community transmission happening, that you can safely get people in and out without exposing them to the coronavirus. That'll be really important too.
Lauren, it's December 23rd. I just checked. We've been dealing with this for almost a year. Are you surprised that we don't have a better plan for exactly how people are going to get it, a bigger national plan in each country to try to get the rollout more even?
Yes and no. I think the vaccine came online incredibly quickly. Even, the scientists who are working on it, I think to an extent are surprised by that. I think some of us are surprised by the lack of staff, how impactful the lack of staff has been. We've had a healthcare provider shortage in the U.S. for a long time. It's gotten worse, and I think we overestimated our volunteer workforce to an extent, and that is impacting our strategies for vaccine rollout. I think everyone is surprised by the lack of national strategy broadly across this pandemic response. So not just vaccine allocation, but testing, PPE shortages, sharing of resources across the country as the outbreak moves to different parts. All of that, I think a lot of us in preparedness and response were really hoping that our planning and our preparedness activities would lead to a more systematic strategy across the U.S. rather than the piecemeal or patchwork strategies that we're seeing implemented at the states levels. And state and local planning is incredibly important, and that's where all of the activity begins. But a national strategy for something like this is absolutely critical, and that's where the surprise lays, is not really having that.
Lauren Sauer of Johns Hopkins, thank you so much for being with us, and congratulations on getting vaccinated. Be sure to check out Virus Go on the Bloomberg for the latest information. And tune in every day for exclusive conversation with Johns Hopkins experts for an inside look at battling COVID. Taking a look at the optimistic tone, we're a little bit off the highs from earlier today. Nevertheless, you are seeing an ongoing outperformance of that cyclical sector, with the Russell now 1994 up 0.5%. Coming up, we are going to be speaking with Pat Foy, head of the MTA, about the potential for more stimulus. This is Bloomberg.
Chinese brands now account for 7 of the country's top 10 cosmetics lines, up from just 3 in 2017. That has pushed out foreign brands like L'Oreal's Maybelline, which has seen its share of China's makeup market plunge by half since 2010. For more, we're joined by Bloomberg editor Bruce Einhorn. Bruce, why the drop?
Chinese brands are becoming much more adept at reaching Chinese consumers, especially now at a time when more consumers are reluctant to go shopping outside. People are spending more time at home. People are spending more time on social media. Chinese brands are very good at using social media, using live streaming, using other things in order to market. Chinese brands also tend to be less expensive, and so at a time when the economy is struggling a bit, there's a lot of uncertainty, people are more budget conscious, Chinese brands have a bit more of an advantage.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
This stimulus really is a stopgap. It's come really late, and
I don't know if it makes a lot of sense to be giving people that have jobs and incomes checks at this point.
This is not a normal environment, far from it.
Next year, it's going to be about inflation expectations, and that's where there could be some surprises.
It will take a very long time before we have a sense of normalcy again.
Once the vaccine arrives, put on your seatbelt. I think this economy could really rip.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. It's a simulcast on Bloomberg Radio, Bloomberg Television. Jonathan Farrow is off. He's on Tier 7 lockdown. He's watching Ted Lasso. I've seen it like 7 times.
He's getting vegetables.
They're being
airlifted in, I hear.
Vegetables.
Vegetables.
Vegetables is how you say that. Boy, was I corrected this morning off the London desk. There's news there. France, I guess, blinked, and they're going to make the trucks go across the channel, under the tunnel. Merkel's going to do a Lufthansa Merkel plan, airlifting in vegetables. A scene there. I think it's unloading Christmas gifts.
Of course.
And
you're hoping to get one of them.
At the Abramowitz household.
Yeah.
But there we are, folks. It has been an extraordinary day, and if you're just tuning in on radio and TV, it's real simple. Markets up 8. Nothing else is going on in the markets, and everything is focused on one of the most historic 4 minutes in the history of this nation last night. We will get to the president and non-stimulus in the morning. Lisa, what do you have lined up for today?
Yeah, and we will be talking more about that Twitter post where President Trump said that he was not happy with this fiscal support bill that was passed, the $900 billion bill that was thought to be a stopgap measure. The data dump that we're all waiting for at 8:30 a.m. We're going to get a read on the economy every which way until tomorrow. U.S. initial jobless claims, personal income, spending, that's all coming out, looking for an ongoing deterioration. My question, Tom, will it matter? Is bad news good news, meaning more stimulus, or bad news just bad news because people are suffering? 10 a.m. we'll also get a sense of that higher frequency economic data, December, University of Michigan consumer sentiment coming out. And at 12 p.m., the National Institute of Health Director Anthony Fauci on Bloomberg TV, perhaps he will tell us about his inoculation as well as what he sees for the path of the pandemic. But Tom, really the story is President Trump coming out, putting the kibosh on the idea of an easy passage of this bill, the idea that perhaps he wants more and he's willing to torpedo members of his own party.
We've got any number of stories this morning, but really it is overwhelmed by the history of the moment. Kevin Cirilli, our chief Washington correspondent, joins us this morning. Kevin, I've got to drive forward to this crazy day, this Wednesday in a new Washington. What will you be watching today after the president's speech last night?
Republicans, and in fact, President Trump, in his deliverance of his message with regards to increasing the stimulus checks to $2,000, got immediate applause from Democrats, including Congresswoman Alexandria Ocasio-Cortez, who came out and said that they will introduce an amendment immediately to replace any references in the fiscal stimulus package of $600 to $2,000. Speaker of the House, Nancy Pelosi, tweeting out moments after the president made his statement saying, quote, let's do it. But Republicans are cautious. Republicans now, and the president knows this, are cautious about spending too much money. And as a result of that, there is so much unknown as to whether or not should the House of Representatives take up new legislation in what's known as a pro forma session on December 28th or December 29th, if the Republican-controlled Senate would be able to pass that vote.
Senator Schumer of New York said, Kevin, let's do this deal and then argue about $2,000 later. Is that the core Democratic strategy, or is there intelligence strategy to say, okay, we're on the side with the president, let's just wait and see what happens after Georgia?
That's the Republican strategy. The Republicans are saying, let's do this deal and let's talk about additional stimulus checks later. And that's based upon the conversations that I've been having last evening as well as this morning, but also in terms of the public comments that have come out in statements from people like Senators Lindsey Graham, a Republican from South Carolina. The clock on this is rapidly moving down. December 28th and December 29th are the last possible days for the votes in the House in order to take this up. The Senate will then be reconvened shortly thereafter. So either way, this is a fascinating development where from a political analysis perspective, the president now being able to say that he pushed for additional stimulus for American families on the cusp of the Georgia runoff election. He also now is able to realign himself with a populist message in the final weeks of his office, and he's garnering praise from some of his most fiercest adversaries, politically speaking. Last night, when this announcement was made, I was speaking with a prominent liberal progressive source who essentially said to me, he's right in terms of the fiscal stimulus checks. But the question becomes, what happens for Secretary Mnuchin? What happens for the president's economic team as they try to negotiate this, as they were at the negotiating table for the past several weeks?
Yeah, what happens over the next 2 weeks when the government shuts down because it doesn't have a funding agreement? Are there enough votes in Congress to override his potential veto?
Yes, especially on certain areas with regards to the veto as it relates to defense authorization. But I don't think Democrats, I think Democrats view this as an opportunity to increase the funds for Americans and American families. And as a result of that, this is forget the fourth quarter. This is an overtime battle for this stimulus bill that now puts us into the early part of next week in the window, and it is a small window between the Christmas holiday and New Year's.
So this Twitter post that President Trump put out was at 7:15 p.m. Tom, I watched this. It came out. I saw the headlines, and I thought it is going to be difficult in markets tomorrow. People are not going to like this.
You got
fiscal
that wrong.
support bill.
Nailed that.
Yeah, I nailed that. Put all my money in the triple leverage cash. Absolutely crushed that call. And today, no one cares. I think that's fascinating, Tom.
That's amazing. Futures up 7, they're up 12 early. Kevin Cirilli, what is so important here, and folks, I'm falling back on Mr. Brunel, an 8th grade civics class at Minerva DeLand High School, Fairport, New York, 14450. Kevin, you split the difference. If everybody comes out this morning and goes $1,300, does that get it done?
No.
Why?
Because I think from an economic data perspective, I think if you look at the comparison of allocations that have been given, that government assistance has provided to families, not in the United States, in Europe, in the UK, in Germany, in France, and you simply pull up the bar chart of where American allocations have come from, America has been consistently lower beneath that level. And so $600 check to families that have been pummeled by the economic impact.
Oh, I agree,
of
but
this.
come on, instead of 600 or 2,000, just split the difference, 1,300, and everybody head home for the holidays.
But on the cusp of the Georgia runoff, to look at it through a political perspective, where Raphael Warnock and Jon Ossoff, the Democratic challengers, are attacking politically Senators Perdue and Loeffler on their closing argument, which is no economic stimulus. From an economic standpoint, from a political prism, this would allow the Republicans to close out that argument in Georgia. And Senate Majority Leader Mitch McConnell definitely wants to keep a Republican majority. This is an argument to do so from the politics of it. But whether or not turnout will come out for this, we don't know.
Yeah, well, I got to say, Kevin, you answered that so diplomatically. You could have just said it's politics. When is it ever, Tom, that simple? Kevin, I do wonder, though, given President Trump weighing in on a more populist tone, whether this gives a little more momentum to the Democrats heading into 2021, even if they don't get a majority in Senate, to get some additional support passed.
Well, the Democrats are yes, it does. And Democrats are increasingly bullish on their chances in Georgia. Yesterday, I spoke with Congressman Jody Hice. He's a Republican from Georgia. He represents an ultra conservative district. He has been echoing President Trump in terms of the unfounded criticisms of voter questioning the legitimacy of the 2020 election. And he was at the White House for a nearly 3-hour meeting earlier this week with President Trump. And I bring this up because I spoke with him before the announcement of last night, and what he was critical of was the $27 trillion in debt. So the president has this ability to be able to bring on board ultra-conservatives who are worried about the debt, but whose constituents are in lockstep with and loyal supporters of the president. the president is going to need people like Congressman Jody Hice of Georgia to get on board with $2,000 checks in a very short window if he wants to be able to do this.
Kevin, thank you so much, and particularly for the reporting beginning at 8 p.m. last night. Mr. Cirilli is our chief Washington correspondent. Bloomberg surveillance and all of Bloomberg is about conversation. We've tried to do that through this pandemic. Dr. Fauci will join us in the 12 o'clock hour, I believe it is today. And coming up in our next hour, Stephen Hahn will join us, Dr. Hahn of the FDA. Lisa, I think we drive forward the issue of the vaccines, and there's just this raging debate into this week that's been subsumed by the politics over who should get the vaccine.
Yeah, and actually, this just crossing the wire that Pfizer and BioNTech are going to supply an additional 100 million supplies of the vaccines to the United States. The United States was working with them to secure some more of the inoculations. All 200 doses are expected to be delivered by July 31st, so getting with that time frame. This has been the backdrop to a lot of the conversations, right? How long of a bridge do we have to gap to get to the other side? And it seems like perhaps we're getting a clear time frame that perhaps July 31st before we get some more of a critical mass.
What I'm hearing and what I learned yesterday, folks, and some of this was Secretary Azar over on Fox, but the other experts as well, away from the politics, was we need to get to 60%, 60% of society vaccinated, and that, Lisa, gets you to the when, which is the when, the optimism of March and April, or is the when, as you mentioned, into the summer.
Kevin, I love how, Tom, you always put Kevin on the spot and you ask these questions. Let's just split the difference. And he has to dance around just saying, it's politics, Tom. When did they ever come up with a simple answer? They had a 5,539-page bill that they put out hours before it passed, and then the president comes out and says, nah.
Okay, fine. The timing I get, but come on. You've got the legislative branch. Somebody proposes, somebody disposes, and the president is part of the discussion. In this case, the president's a little late to the discussion, but just split the difference and go home.
Yeah, sort of like John Farrow. He was a little late, so he didn't show up today.
That's what you'd hope to do. Futures up 6, Dow futures up 50. On radio and TV, this is Bloomberg. Good morning.
With the First Word News, I'm Ritika Gupta. Now President Trump is signaling he might not sign that massive coronavirus and spending bill passed by Congress. Last night, the president called the bill a disgrace and said it's filled with wasteful and unnecessary items. He demanded that Congress increase the stimulus checks going to most Americans from $600 to $2,000. And President Trump handed out a number of pardons, including one to a former campaign aide. George Papadopoulos was convicted of lying to the FBI in Robert Mueller's Russia investigation. The president also pardoned former California Congressman Duncan Hunter, who pleaded guilty for misusing campaign funds. Another former Congressman, Chris Collins, was pardoned after pleading guilty in a securities fraud case. Israel and Prime Minister Benjamin Netanyahu are headed for their fourth election in 2 years. The country's governing coalition collapsed after just 7 months over a budget crisis. The vote is set for March 23rd. Both Netanyahu and the leader of the opposition Blue and White Party, Benny Gantz, enter the campaign badly weakened. France has agreed to reopen its border with the UK. That comes after a suspension that crippled Britain's busiest port, Dover. French authorities say EU citizens and residents able to show negative coronavirus tests will be able to travel from the UK, plus freight traffic has begun to move. And Pfizer and BioNTech have just agreed to supply 100 million more doses of the coronavirus vaccine to the U.S. government. There have been reports that the U.S. had declined an offer earlier this year to buy more of those shots. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
COVID-19 pandemic has hit the U.S. economy hard.
But the damage has not been evenly distributed.
Now comes the challenge to rebuild more equitably. Join us for a Bloomberg special report, The Unequal Recovery, on Bloomberg Television.
I'm asking Congress to amend this bill and increase the ridiculously low $600 to $2,000 or $4,000 for a couple. I'm also asking Congress to immediately get rid of the wasteful and unnecessary items.
Absolutely extraordinary. The president, a 4-minute, I'll call it, video last night in the 7 o'clock hour, bombshells exploding in the 8 o'clock hour as he adjusts the stimulus debate. We'll have much more on this through the morning as well, on the budgetary process, but also the political process for Georgia, 13 days away, those important 2 Senate elections. Right now, not on strategy, and not on fixed income or equity or FX and what to do, but way more important, you've missed this market and you need to get back in. Steven Chivarone is with Federated Hermes and is really, really quite good at the allocation game. Steve, what's the plan for 2021?
Well, look, we think, I know that this has been beaten to death because it's becoming the consensus, but we've said all along, the biggest stimulus that's going to come is the vaccine. And we think, again, rates are going to stay low. You're going to get a stimulus eventually, this most recent lump of coal notwithstanding. And then the vaccine, we think 2021 is going to be a very good year. And we like the underloved parts of the market. Small caps, value cyclicals, dividend payers have kind of risen to the top of that list more recently.
Yeah.
And international stocks.
What about the call? And I think of Credit Suisse, which has really gone against consensus on small cap, and they say tech will still do well. Do you abandon the successful stocks of the last 18 months?
No, there's nothing wrong with tech. And we think on an absolute sense, it'll do fine over the next year and probably over the next 3 to 5 years, continue to be the winner. The story is incremental news flow, though. Next year, if the economy is open, all of the chips won't be in the direction of tech the way they were this year. Other businesses on a year-over-year comp are going to look far better, particularly those ones that have been most severely impacted. So we think over the next 3, 6, 9, 12 months, you could see those other parts of the market outperform. But that doesn't mean tech is going down. It's going to continue to move higher. Just we think underperform some of those.
Lisa, this is just absolutely critical what Steve is talking about. Is this an absolute move or a relative move? And that's a debate we see on surveillance.
Yeah, well, he also talks about the news developments. And I do wonder, the flow of news, when does it matter? We're going to get a data dump here in about an hour and 10 minutes here. We're going to get unemployment. We're going to get personal spending. None of it ever matters. Bad news is good news. Good news is good news. When does that change, Steve?
Well, I mean, Lisa, you know I've been pretty constructive. Even I thought the market might be down a little this morning after the announcement last night. Look,
so you agree with me. You also went into all cash immediately. No, I'm kidding. Go on.
No, I didn't do that. I didn't go that far.
Carry on.
No, we still have to make money. But no, look, I think there's a valley that we all know about and that the market understands, and that's this kind of third wave before we get everyone vaccinated. I don't think the market really is concerned with how deep that valley is. I think anything that would make that valley last longer, then the market might worry about that. So if the vaccine didn't work on the mutant strain, right, that would have been a problem. But it does, at least as best as we know so far. And so it's almost irrelevant how deep this valley is because we think we'll get some stimulus one way or another. The question is are we still on track to get the country vaccinated at some point in the middle of next year and then get a recovery? And as long as that's in place, you know, this market has been relatively Teflon.
So here's what I'm struggling with. When we get economists on the show, they say it does matter timing with respect to when we get the money, because if we let the unemployment benefits expire, if we have people not buying as much, that could have a longer lasting effect. Then we have people who are investing in the market come on and they say, nah, it doesn't really matter when it gets here as long as we get it. Can you square that difference?
Yeah, I think they're both right. I mean, I think from an overall economic perspective, and particularly those companies that make up the investable market, these larger companies that have plenty of access to capital, the economy overall doesn't need stimulus. However, from a humanitarian perspective, like put the market aside for a second, from a humanitarian perspective, there's a whole bunch of people that are going to have a really difficult Christmas and New Year's. There's a whole bunch of restaurants and small businesses. And it would be a shame to see them go through undue pain because the folks in Washington can't get their act together. I mean, we've had 8 months to figure this out. So right. I think they're both right because, right, from a market perspective, you know, if a stock misses one cash flow in a stream between now and infinity, that doesn't really change what that company's worth.
Steve, to the heritage of Federated of Pittsburgh, and that is money market funds. You guys built the franchise. You guys own that. What is your best research on the reality if I have $100,000, I'm not making 1%, 1,000, I'm not making 100, I'm making $10 or $12, or maybe I'm living large at $16. What happens if rates continue down to the great money market funds of this nation?
Look, I think money market funds still make a ton of sense, even in a low rate environment. First off, what's the alternative? Being in a deposit account? And rates are even lower in the deposit accounts. There's really no opportunity for when rates rise for those deposit accounts to provide you with a higher interest. The other issue too, Tom, and I think this is important, is, you know, cash is an asset. It provides flexibility. And we do think that rates will move higher eventually. Now, is it going to happen in the next year or two? No, probably not. But our view is that this economic recovery, once it really kicks into gear, could be faster and stronger than folks expect. And maybe the Fed isn't at zero as long as everyone currently expects. You know, the other element, too, I would say is how you actively manage that cash. Are you able to be investing that in companies that are good stewards, as an example? I think there's a lot of reasons to still use money market funds. Obviously, they're not as attractive. The other option, though, is to crawl out the yield curve, whether that's into micro shorts or ultra shorts, where you can pick up a little bit more yield, but not a whole bunch more risk.
Stephen, thank you so much. Stephen Chivarone with us with Federated Hermes. I really can't say enough about his approach to portfolio management and on to asset allocation as well. Lisa, you know, this is so important of this differential between America and, to an extent, England versus continental Europe on negative rates and that trajectory and money market funds. That's the great unspoken of 2021.
Yeah, and we actually saw a number of big financial firms close money market funds this year because they couldn't provide the same kind of return, or at least a positive return, given fees on some of these money market assets. It really raises a question of how much leverage the Fed has, Tom, at this point to potentially stimulate with lower rates.
I mean, we're going to have to see on that. Let me do a data check right now. Futures up 6, down futures up 51. In nicely on the VIX from 31, we scream into 23.62. Actually, a little bit more calm earlier, but the tape nevertheless with a lift, and particularly off the shock that we saw out of Washington. I really can't say enough about our medical coverage here that we're going to do. Dr. Hahn will be with us with the FDA in the next hour, just after that wall of economic data. And then Dr. Fauci will join Bloomberg, I believe, in the 12 o'clock hour. That is a really sterling perspective on this pandemic as well. Again, the bond market not showing much right now, 0.92% on the 10-year yield. On radio, on television, Lisa Abramowitz and Tom Keene. Stay with us. This is Bloomberg.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns, welcome to Bloomberg Big Decisions.
We have always been a mixture of things. We are always stronger for that mixture.
Growth is a way to stay competitive, delight more and more consumers.
Are you worried that people won't take the vaccine?
We remain concerned about vaccine hesitancy.
What is one word of advice you'll take with you?
Learn how to listen. And that is certainly something that has served me well.
Ankiti, where do you go from here?
It's a huge market. It's a huge opportunity. I want to go 100x from here.
Our philosophy is to partner where we can and stand apart when we should.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Good morning, everyone. Bloomberg Surveillance on radio and television. Truly a remarkable day. I thought we'd slide in here today. Some economic data here at 8:30 in 1 hour. No, not to be had on radio and television across this nation. The president with a bombshell last night, a 4-minute speech where he said, no, I'm going to insert myself into the stimulus process. And I'll be honest, after 3-4 conversations, I'm not really sure where we're heading this morning. We'll learn a lot more about that through this day. Lisa, your thoughts on the president's comments?
I just want to point out that Steve Chivarone, who is much better at asset allocation than I, had the same reaction, Tom. So perhaps I was completely wrong that I thought that markets would take the news from President Trump last night as negative, but others thought the same. I think it is telling that people are interpreting it instead as positive in the sense that perhaps this means more money longer term.
Yeah, well, we'll have to see. I got a lot of ways to go. Very quickly here, Lisa, you put out a tweet this morning. Unfortunately, it was smarter than anything that I did, and it was on corporate yields coming down, 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 down. It is surreal. It's just simply a demand for the paper, price up, yield down. It's that simple, right?
It raises a question, where do you go for income? Investment-grade bonds in the United States are now yielding 1.8%, paired with the all-time low. Just to give you some perspective, Tom, U.S. Treasuries, 10-year U.S. Treasuries were yielding more than that in January, before the pandemic. I mean, it just raises a question, if you want income, where do you go? Are stocks the new bonds, given that you can get a dividend, at least, that's much higher among some stocks? How much risk do you take on not going in to risk, Tom?
Joining us from Florida with a distance from Wall Street with Eagle Asset Management, James Camp joins us this morning. James, I want to go right to the heart of the matter, which is diversification, and as the great Peter Lynch once said, diversification as well. Was diversification your friend in 2020?
Well, I think it was, but if you began and ended the year and just looked at asset allocation, you might think you stayed at the same place. But as Lisa mentioned, early in the year, bonds were actually quite generous relative to equity, the equity income side. In fact, you had T-bills out yielding the 10-year. So I think the key is going to have to be tactical income and asset allocation around the different sleeves of income generation and not the traditional static 60-40 portfolio.
James, your charm is you're really front and center with people worried about their money. Is a general statement, how many people that you talk to, institutional and retail, as you structure portfolios, how many of those people are agonizing because they feel they're behind?
Well, there's a couple of things to that question, and one of them is if you look at the S&P and you look at your utility of generating income in a non-S&P portfolio, it fails the eye test, right? Because such a narrow band of the S&P has really been the performance drivers, and those have not been the income securities. But the converse of that is people that are looking at year-end, they're rolling CDs, they're looking at money markets now that are essentially destroying capital at zero. And now they're getting this, gee, where do I go for yield to the question? And the interesting thing is a lot of those equity securities, which lagged in a total return sense, they actually have produced or are producing even more generous yields as we roll into 2021.
All right, so are you recommending to people, or are people in liking the idea of going into dividend stocks in lieu of bonds, replacing their bond allocations with equities?
Yeah, Lisa, not wholesale, but judiciously. And one of the things we have to remember is the recession of 2020 was actually quite less problematic for the dividend payers. We had fewer cuts, fewer curtailments, and fewer suspensions than we did in 2008. As you mentioned, with stimulus and other things, there's a tremendous amount of velocity in money supply being created in corporate indebtedness, because they were able to issue massive amounts of debt at these low yields because of the Fed and Treasury's, marriage, if you will, back in March, April. Their balance sheets are actually in pretty good shape, and the safety and compounding nature and the growth rate of those dividends is actually in pretty good shape as we head into 2021.
I got to say, James, the TINA trade has been the driving force in markets for years now. There is no alternative. Bond yields go down and everybody floods into stocks until it runs out, and basically you start to see that stocks can have a negative return. You can have a problem. At what point does the TINA trade run out this time? What do you see as the catalyst that could check people's risk impulse and get them to pile back into the safety of something like bonds?
Well, inflation and growth, and those are two parts of the same coin. What's going to happen is the base effects, as I think you've mentioned, March, April, we're going to have PCE higher, we're going to have GDP higher. We are consuming at pre-pandemic levels, but we're not producing at pre-pandemic levels. Commodities are higher. So I think what derails the equity market is a spike in bond yields, and that may come sooner than people expect. We have flooded the bond market with capital, and all it takes is the bond market to get spooked. We don't have to have inflation run away from us. we just got to get spooked enough to have that trade reverse. And I think bond yields go higher, and that puts a little bit of a brake on the stock market.
Oh, James, you know, we're addicted to this. And I mean, you got to deal with this. And I deal with it with a wall of cash. It's out there. We talked to Liz Ann Saunders of Schwab, I believe it was yesterday, about the same idea. I get the theory. And I get that if I have a bond portfolio with Eagle Asset Management and I'm down 3 months in a row, I'm miserable. I get all that. But the fallback is there's a wall of money out there. Do you look at that wall of money as a source of funds for a bid to the markets, plural, or is that wall of money an institutional artifact that's going to stay there forever?
Yeah, it doesn't seem to have been cut loose here, and so it may be just a permanent part of the capital stock. And if you remember, you know, back in the 08 experience, we had a lot of money just kind of tied up in the plumbing. You know, the repo market is one thing that's kind of interesting, maybe a different topic, but we're funding a lot of these treasuries at essentially zero. And as long as the Fed is going to make institutional funding costs and broker-dealer funding costs zero, you know, 1.25 on the 10-year is going to look relatively attractive.
Okay.
And so we, yep.
I don't mean to interrupt, James, but we're running out of time here, and this is really, really important. What's the official James Camp yield hog meter say right now? I mean, Abramowitz is following this every day, almost on an hourly basis, folks. And to me, it's screaming 2006 James Camp, where we're trying to parse out basis points. Are we back to that foolishness?
Yeah, and you see some of that in the cash markets. You see people shopping for yield with cash, and cash is the stuff that you keep in your wallet. The cash is the stuff that's meant to be safe. We do have products, and we do have, you know, folks going for 10, 15, 20 basis points of yield, which is inconsequential from a wealth standpoint, but very consequential from a risk standpoint. So 0% interest rates, they have effects of people's behavior, and they affect corporate behavior, they affect investor behavior. The best approach for the individual is to be agnostic about your income generation, to be judicious in owning stocks versus lending when that's efficient, and be ready if bond yields do reverse.
I'm looking for an entry point, Lisa. Camp's not getting me out of it.
Yeah, I was about to say, James, what would you recommend to somebody like Tom Keene or someone else, theoretically, who has their money in quadruple levered cash fund? What are you up to at this point? You're quadruple levered cash. Yeah, that's right. James?
Well, as uninteresting as a 1.8 corporate bond yield is, it's still a lot more interesting than cash, and probably going to be just fine long term.
Yeah.
So if I need to get Tom out of the cash market, we probably have to have a longer conversation.
Okay, I'm going to go to a Florida conversation, James Camp. The acclaimed Douglas Cass, who pillared me because in the stimulus bill is $400 billion for the Boston Red Sox. But James Camp, Cass is long-term bullish on Amazon. What do you do at your shop with institutions or retail that got lucky? They bought Apple for nothing, Amazon for nothing, like Lisa's kids. I mean, what do you do with these people with ginormous tech gains?
Well, I think one of the conversations that we have is go back to the asset allocation trade. And if you have high yield, if you have some of these flying stocks and you've created a capital base that was significantly higher than the capital base you put into the markets, if you roll that cost basis into income production at these levels, your net income relative to the actual entry point in those stocks is going to be significantly higher. So you can do some optics with what those yields really look like on a net basis. But at the end of the day, look, we have Tesla that's now, bigger than all the other automakers combined. We have options that expire in a week that are 70% of the options market in some of these tech names. We know what retail is doing, and it is scary. We know our Uber drivers and our delicatessen managers are asking us about things like Tesla. That always scares me.
James Camp, Lisa from Central Park West emails in and says, why is everybody moving to Florida? Do you have a massive boom down there?
We have sight unseen bids on houses in our neighborhood for people on the West Coast and for people up in your fine state of New York. It does feel that way. But I will tell you, we do have a dearth of our friends up north of the border because of COVID. So I think it's kind of a push right now.
James Camp, thank you so much. It's really wonderful there at the end of the year to get the realities, folks, of portfolio management and this distress of a wall of cash out there. Lisa, I learned a lot there about the pressure where somebody actually walks in an office, sits down and says, man, have I missed this? There's a lot of that out there.
Yeah, I think about that when it comes to the weather in Florida right now versus the weather in New York City. I will say
they're moving.
That is, they're moving. And the question is,
vengeance.
how much are people going to return to the big city model? I was thinking a lot about this morning, and frankly, for all of the year, there was a story about how much office demand may or may not come back. It's a really controversial issue, Tom, with one estimate this morning that I was reading about 10 to 15% decline in office space demand after the pandemic.
I'm in the camp of being London and New York Philip. I just think it will come back with the vaccine, and with what we see there, it will come back.
Well, you know, I will say this: where do you go for vacation during a pandemic?
Nowhere.
I mean, what do you do, right?
McDonald's,
and then how do you McDonald's? What is number two value meal? But to me, there's a question. Your kids are homeschooling. They're not getting out. They're not seeing friends. You're not seeing friends. Where do you go to give people hope?
Watch
right?
Mandalorian for the third time.
All right,
that's
what
it. You do.
Straight to you. Breaking news on Bloomberg Surveillance. Mandalorian.
Yeah, well,
3 times.
you know, my failure this holiday season, folks, is I have gone down in flames because I don't have Baby Yoda atop of the Yule bush.
That's the choice.
That's all I'm hearing about.
Baby Yoda?
They want Baby Yoda at the top of the damn tree, and I'm like, you know, what I pay for that tree itself. New York City and Christmas trees, Lisa, come on, it's a scam.
This is the reason why you've been sleeping under your desk, huh?
That's why people move to Florida with James Camp, is the trees are cheaper down in Florida as well. So this is very funny, but it is not funny for Patrick Foy. It is really serious, and it is wrapped around the stimulus. The president speaks of funding to Cambodia. How about funding to the transportation systems of our great democratic cities? Foy of the MTA, look for that. We'll do that here in a bit. Economics at 8:30. This is Bloomberg. Good morning.
With the First Word News, I'm Ritika Gupta. Now President Trump is signaling he might not even sign that massive coronavirus and spending bill passed by Congress. Last night, the president called the bill a disgrace and said it's filled with wasteful and unnecessary items. He demanded that Congress increase the stimulus checks going to most Americans from $600 to $2,000. Meanwhile, Joe Biden warned that the darkest days of the coronavirus pandemic were still to come. The president-elect called on Congress to be ready to produce another stimulus package early next year, but he's not putting a dollar figure on it. And President Trump's trade czar is leaving next month, hailing the tariffs that his critics hate. Robert Lighthizer rejects the consensus from economists that the duties on imports from China and steel from around the world have been a failure. He says that in 5 of the 6 quarters before the pandemic, there was an increase in the U.S. trade deficit. Plus, Lighthizer says the tariffs helped lead to higher household income. A post-Brexit trade deal hangs in the balance, with fishing rights still the key issue. Prime Minister Boris Johnson and European Commission President Ursula von der Leyen have intervened. They're making a last-ditch bid to reach an agreement before the UK leaves the single market at the end of the year. And Elon Musk says that years ago, Apple CEO Tim Cook refused to take a meeting to discuss buying Tesla. Musk indicated the price would have been about $60 billion, roughly 1/10 of its current value. Musk says he reached out to Apple in what he called the darkest days of the development of the Tesla Model 3. Apple's not commenting. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
Substantial further progress means what it says. We'll be looking for an inflation to be substantially closer to our 2% longer run goal before we start making adjustments to our purchases.
That's a long time to be very accommodative, but that's basically the horizon.
They can buy more bonds and they can buy longer maturity bonds, and that would put more downward pressure on long-term interest rates.
We explore the trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
Unemployment's extended for another 10 weeks. It's going to take a lot longer than that. But Congress did its job this week. And I can and I must ask them to do it again next year.
And then the conversation changed on Bloomberg Radio and Bloomberg Television. An extraordinary Bloomberg surveillance this morning. Again, Dr. Hahn of FDA with us later. Dr. Fauci later in the morning, I believe in the 12 noon hour. The president blowing up the dialogue last night in the 7 o'clock hour. What is so important here, and I listened to the entire 4-minute video, I believe the president led with the cuts he needs, or the complaints, I should say, starting with the funding of Cambodia. There are others out there worried about the good that is within the bill. We heard that from, among others, Senator Schumer of New York. And let's cut to the chase. Is it about Cambodia, or is it about the N train to Coney Island? Patrick Foy joins us, who knows about the N train to Coney Island. To be clear here, Mr. Foy and the MTA, you're funded within this present bill, so the N train runs to Coney Island, right?
Morning, Tom. That's exactly right. Thanks to Senator Schumer's intervention, the bill that was passed by the Senate and the House earlier in the week provides over $4 billion of funding for the MTA. It's critically needed. The effect of that is it will cover almost all of our deficit in 2021, and the drastic service cuts that we've been talking about on subways, buses, commuter rails, and laying off up to 10,000 of our colleagues will be avoided at least in 2021.
If the lawyer from Fordham and Skadden Arps gets a cup of coffee this morning with the President of the United States, how do you straighten him out?
Look, I think the American people need relief. States and cities need relief. Transit agencies need relief. And the MTA definitely needs relief. The bill that was passed earlier in the week is incredibly important for the MTA, and the MTA is critical to the economic recovery of New York City. Not having to make reductions on subways and buses up to 40% service reductions and 50% on the commuter rails, and avoiding laying off 10,000 of our colleagues is incredibly important to the New York economy. NYU's Rudin Center said that we could lose up to 450,000 jobs in the region if we had to make these cuts, and about $60 billion of gross regional product. That's a national issue. This bill gets it done. President-elect Biden's right. There will be a need for additional negotiations and legislation and relief next year, but that's next year. This bill, it's really, from an MTA point of view, a matter of critical urgency.
And just to give you some numbers behind it, $14 billion of aid was committed for public transit in the bill, at least $4 billion of that going toward the MTA. How much time, Pat, does that buy you before traffic on the subways, on the buses, really has to pick up back to something that resembles pre-pandemic?
Lisa, it buys us a year. It buys us all of 2021. It covers the $4 billion plus covers the MTA deficit in 2021. We'll need more relief then. But to get us through this year is extraordinarily important. We won't have to lay off 10,000 people, and we'll be able to continue and grow the service that we're providing for the essential workers and first responders and office workers as they return to New York.
So, Pat, there's a concern about whether people will have the same confidence in public transportation post-pandemic just because of the incredible response and the potential for transmission of disease. What are you finding? How are you convincing people that it's not a vector of disease and that they will be safe coming back to the subway even after the vaccine?
Great question. So a couple of things. One is we're disinfecting, not cleaning, but we're disinfecting every subway station and subway car Same on commuter rail, same on our paratransit vehicles multiple times a day. We are innovating in terms of air exchange, antimicrobials, ultraviolet, sea light, and other products, some of which are in place, some of which are being piloting, some of which we're experimenting with government agencies. Around the world, no vector of coronavirus 19 has been identified with mass transit. Governor Cuomo's reported recently that about nearly 75% of transmissions occurs in private gatherings in homes. Transit, all of our passengers have to wear a mask. It's a matter of state law as a result of the governor's executive order. And compliance is extraordinarily high, well over 95% mask compliance.
What have you seen in the last couple weeks, Pat Foy, in the statistics? Are people, it's frankly after 9/11 with that immense fear of getting on trains. Is the fear receding?
I think the fear is receding. The ridership declines are worse than the Great Depression. In the worst days, March and April, subway ridership, for instance, was down 95%. It's now down about 70%. That's a huge drop, but still, it's great improvement. On subways and buses, we're close to carrying 3 million passengers a day. Makes us the largest transit system in the country, comparing our peers to pre-pandemic levels. But we've got a long way to go, and ridership is increasing, and I believe will continue to increase.
Mr. Foy, I want you to speak right now to the cities across this nation listening on radio and TV. You know what? They're not New York. They don't have the transportation grid. They're stuck in traffic out on some highway somewhere. Speak of how your world overlays with people stuck on Bloomberg Radio in some traffic jam right now, say in Dallas or in San Francisco.
Well, first, Dallas and San Francisco have mass transit systems, and there's more transit systems around the country than is commonly perceived. We're obviously the largest. But what I tell your listeners, for instance, in Nebraska, Tom, is that there are 2,000 Americans working in Lincoln, Nebraska, building cars for Kawasaki, for New York City Transit, for the New York City subways, for Metro-North and Long Island Railroad. Our capital plan, $51.5 billion, which is on pause, touches nearly every state in the country. And that's why the Rudin Center indicated that there'd be this national effect if we had to cut service and our capital plan.
A good update. Patrick Foy, thank you so much. And again, for all of us at Bloomberg, just superb year I can't tell you, folks, the essential services, what they have done here, just to witness it in the confined space that John Farrow, Lisa Bramwitz, and I are in. It's been really extraordinary, Lisa, to see this year.
I want to say something. You were talking about other cities across the United States and their public transportation, and it reminded me of Austin, right? Because there's so many businesses moving to Austin, and one of the big challenges of Austin is that it doesn't have a sophisticated public transportation system.
Oh, it's horrific.
And the traffic has been a real concern.
Yeah.
In November, they approved a $7.1 billion plan, but it just raises this issue. How much of a cap on the expansion of some of these very hot cities now, both literally and figuratively, is there going to be based on the public transportation networks that are or are not available?
Huge story. I enjoyed sitting in Portland, Oregon's traffic jam 18 months ago or so, Lisa, and you're dead on that. And Austin, Texas is really front and center. Futures up 7, Dow futures up 57. Boredom reigns in the bond market. Lisa, why?
Yeah, I don't know. Well, I mean, that's classic, right? I think that honestly, people are looking at the Fed to cap any potential upside move in yields, and on the downside, there is a cap because people are expecting inflation to pick up. Same story. Same consensus.
I'm looking at 35 minutes. A raft, as they say, a Seattle slew of data coming out here at 8:30. Durable goods, boring. Cap goods, boring. How about claims? We get claims on this Wednesday.
I'm going to portage.
So that's
that raft.
The raft, exactly. That's an important number. We do claims on this Wednesday. We do that in 30 minutes. Alicia Levine on the equity markets. This is Bloomberg.
se logra una sonrisa de parte de cada persona que utiliza el dispositivo, ya que se pone en situación, entre comillas, de una persona discapacitada. Y ven que lo sorteamos de una forma agradable, porque el simple hecho de sentarse en un dispositivo ya es agradable.
Nace MAT como una solución de movilidad a personas con discapacidad. Nace Mandados como una opción de generación de ingresos y nace MAT Tools como generación de ingresos y educación a las demás personas que no están en silla.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
How have you changed as a leader since that day in 1993 when you joined Roche?
You develop over time, and it's a series of experiences which hopefully make you a better leader.
This stimulus really is a stopgap. It's come really late, and it's a little lame, honestly.
I don't know if it makes a lot of sense to be giving people that have jobs and incomes checks at this point.
This is not a normal environment, far from it.
Next year, it's going to be about inflation expectations, and that's where there could be some surprises.
It will take a very long time before we have a sense of normalcy again.
Once the vaccine arrives, put on your seatbelt. I think this economy could really rip.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone on TV, on radio, the simulcast Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. John Farrow managed to get another day off. Tom Keene will rib him on it consistently. Yeah, well, I will say he evidently is getting vegetables from the shipment that is now coming and crossing.
Cargoing in, the vegetables are coming in from Angela Merkel, Lufthansa, sending in cargo planes into London to provide the vegetables to Mr. Farrow.
To make sure he has his vitamin C. Meanwhile, we're getting some shot of optimism in the markets. I got to say, Tom, yesterday the bombshell that President Trump dropped on Twitter was notable to me. I thought that it would have a negative effect on markets, this idea that he was going to potentially veto the $900 billion stimulus plan. It did not. It had no effect other than to just kind of keep things chugging along. Tom, what's that about?
I think it's a mystery, and what it's about is Washington needs to wake up and recalibrate. This is really important for those of you worldwide and across the nation that don't know capital cities worldwide, frankly. Their early morning is not a surveillance morning. Their early morning is 8:30 is the first cup of coffee, and you really don't get going till 10 a.m. I'm serious, Lisa, and you're going to see a massive recalibration here coming across the morning. I know Kevin Cirilli and David Weston are really on top of that story, including important conversations through today. Cirilli started, of course, very early as well. Futures up 6, Lisa. Dow futures up 54. And other than that, we do have the holiday market. You wonder if economics in 30 minutes upsets it.
Yeah, well, I mean, I wonder if everyone's just gone home. As everyone already is home. Let's be honest. It's 2020. Everyone's already working from home. But holiday season setting in, volumes are pretty low, and you do wonder who's actually trading and making a call at this point in the year, Tom.
Well, let's get it started here, and we're going to do this with, it's very important, folks, as we've learned in the pandemic. It's where you are in the pandemic and what it says about your equity investment strategy. Joining us now, picking up off Mandalorian, is the only woman on Wall Street with an Imperial Star Destroyer in the background.
You think she's the only one?
Alicia, what is that behind you? It's like an Imperial, why do you have an Imperial Star Destroyer behind you? On radio, folks, she's got the ginormous 3-foot model from Star Wars. What is that?
So I have 3 boys who are master Lego builders, and what you can't see are the other Legos across my living room. This is the most impressive, so I put it in the shot, and of course they're thrilled.
That's very cool. Well, we say good to the Levine kids who can kill it at Legos. Come over to my house. They're all under the couch. Let us get started on Bloomberg Radio and Bloomberg Television. Alicia Levine, your framework for next year, given once again double-digit returns.
Yeah, hi, great to see you guys, and Merry Christmas and Happy New Year. Look, we think next year on the fundamental side is going to be extremely positive, particularly in the second half. We're looking for a reboot and a restart and a recover, and I think that's really the theme for next year, as is pent-up demand, because as you know, there's $1.4 trillion of extra savings in U.S. households, and so that is going to be spent. I mean, think of the conversations you have. Everybody has a wish list of what they're going to do. So that really gets into play in the second half of the year, and that's what markets are reflecting right here. Now, are markets the real economy, and how early are they pricing this in? And they've priced a lot in, so we're mildly cautious on the first quarter going into the second quarter. We think there could be a collision here between rising yields and rising valuations in the stock market.
Okay, so before we get to the collision course, let's talk about the concern that a growing number of people have about things getting a bit overheated, given the fact that everyone's 11-year-old is opening a Robinhood account. I mean, what do you say to people who are concerned about that and say, no, we really are at the beginning of a new cycle?
Yeah, so the Robinhood account thing is real. Speaking from, experience, the Robinhood thing is real, and we're all sitting home and everyone has extra time. So I think there is excitement in the market. It's not as overly priced as it was in '99. There are pockets, unquestionably. So we have electric vehicles. We have solar. I mean, the solar ETF is now trading 100% over its 200-day moving average. So I know there's excitement with the Democratic administration, but, folks, let's take a deep breath. This doesn't end well. My favorite line with you guys is that parabolas don't make great technical charts. So you want to think about where you want to enter those more overheated places. I don't think this is the place to do it. Could you go higher into the very end of the year? Of course you could.
Lisa, I'm going to tear up here. Levine goes all Cartesian on us today, pulling out the squared functions. It's too much.
It's okay. You can go take some tea, maybe a martini, and we'll catch up with you after we finish with the Cartesian economics. I wonder, though, Alicia, when you look at the overheated sectors, how do you even determine what that is? When people say, well, we're still not out of the stay-at-home economy, big tech has more to run, momentum has lagged behind for so long, it has more to catch up. These are the arguments we hear every day. What's wrong with them?
So look, first of all, we do like cyclicals, value, and tech into next year. Let me just say that, as well as small cap, okay? So that's our fundamental call for next year. What I'd say is old-fashioned technical analysis of 50-day and 200-day moving averages kind of tells you where the short term is going, and I'd use that as a barometer. We do think that the digitization of all businesses, everything, is continuing and accelerating. So you have to be in tech. You can't just sell one for the other. It's really a barbell. Right. But we are clearly in a cyclical recovery, clearly. And that means steeper yield curve, cyclicals will work, financials will work, and also small caps will work. So you have to be there.
Right. Alicia, what's so important here, and she brings up folks with her prodigious math skills, I should say, seriously, she brings up the ambiguities that are out there. What is the ambiguity for corporate officers, given the economics that are going to be dealt in the next 24 months? To me, once again, we will underestimate how corporations will adjust.
Yeah, so I mean, that was the great story coming out of the bottom here, is that large corporations were more nimble than we ever would have given them credit for, and produced results as early as the second quarter in their ability to adjust. Now, unfortunately, some of the smaller businesses, as we know, were not given the opportunity. We have 20% of U.S. restaurants out of business completely, and I suspect that really undercounts what's going on. But look, corporates have to get through the air pocket, and the air pocket is really the first quarter, leaving December. What we're talking about is the rapid fire of the disease as it kind of races with vaccines. So that's the air pocket. But then you've got, $460 billion in cash that was raised this year, and debt. So we think all that cheap cash and the cheap debt and the expensive equity will be used in M&A. And that's what you're going to see in the next couple of years.
Alicia, you did mention this potential risk out there that yields could rise. Can you talk a little how realistic that is?
So that's it. That's it, Lisa, because, everyone's priced in that the Fed is going to sit on the long end with some sort of yield curve control. But if we really see the cyclical recovery happening, and I suspect we're going to see it fairly soon, i.e. in the second quarter, I think it's going to be hard to keep yields down.
Yeah.
And pretty much everyone on the street has a high of 1.5 basis point, 1.5% on the 10-year for the end of 2021. Where is your risk?
Alicia,
your risk is the upside.
Alicia, nobody cares. Here's what they want to know. On radio and television, I'm getting in emails galore. People want to know the discipline it takes for you to get your kids to put together 4,794 parts or whatever it is of your destroyer, your Imperial Star Wars ship behind you. How do you get your kids to do that big project?
The secret is that I have no fine motor skills, and it's all them. It is them. They asked for it. They wanted to do it, and I gave them all the space in the living room to complete it.
The secret is she lucked out.
Lisa, that's extraordinary. I've got kids that have the two little Star Wars minifigures. That's what we that's what we got going.
My kids play the Star Wars video game. Alicia, congratulations. You've done something right.
Alicia, we are humbled, absolutely humbled by the construction skills of the Levine kids. They'll be over next week, kids, to put together a 200-piece.
Of course, they're going to sleep till 1 today, so they won't have heard what you said today. But
that's okay.
You can show them the recording later.
Okay. 1 o'clock is the new norm for the kids in the pandemic. Alicia Levine, thank you so much with BNY Mellon there, with some real some optimism there in the market.
Yeah, upside potential surprise. I will say that is fewer Lego pieces in the pages in the financial support bill. But still, amazing.
I'm 0 for a million kids on Legos. To be honest, Lisa, I end up throwing the parts out because I end up stepping on them.
That's the worst. I hate that. Well, I mean, that's the problem, is that they have to clean them up well, or else they go out of the living room and then they get put away
you worry
forever.
about vet bill choking on them.
Yeah.
And, it's like the Manhattan
tough
cherries.
Problems.
You don't want to drop them on the floor because the dog will choke.
Everyone's crying into their coffee right now, Tom. Really feeling sorry for us. I will say, though, the activities.
4,784 Lego parts. That's stunning.
That is stunning. What did you do when you were a kid?
Not Lego. We did erector sets, which was different. Erector sets were different.
I did those.
You had actual screws and metal, and you'd make it, but then you'd fail. But then your engineering father would come in and do it for you while you were asleep. So you'd come back the next morning, and it was like the Golden Gate Bridge being built across
Seriously? Just to put you to shame. This is what you should be doing.
Lisa, there was a thing called the Pinewood Derby a million years ago. I had a Pinewood Derby with laminar flow. It was done by, it was totally unfair. They made me lose on purpose because my father, messed it up. Oh, the war stories, folks, here at the holiday season. Alicia Levine, that was fabulous on the Star Wars. We've got much more coming up. Seriously, folks, on the pandemic, Julie Norman will join us from UCL London. Serious news on the death dynamics of the pandemic, and of course, all that economic data coming up here in about 19 minutes.
With the First Word News, I'm Ritika Gupta. Now President Trump is signaling he might not even sign that massive coronavirus and spending bill passed by Congress. Last night, the president called the bill a disgrace and said it's filled with wasteful and unnecessary items. He demanded that Congress increase the stimulus checks going to most Americans from $600 to $2,000. President Trump handed out a number of pardons, including one to a former campaign aide, George Papadopoulos, who was convicted of lying to the FBI in Robert Mueller's Russia investigation. The president also pardoned former California Congressman Duncan Hunter, who pleaded guilty to misusing campaign funds. Another former Congressman, Chris Collins, was pardoned after pleading guilty in a securities fraud case. Pfizer and BioNTech have agreed to double the amount of coronavirus vaccine they're providing to the U.S. government. The two will supply an additional 100 million doses. That will cost the U.S. almost $2 billion. The companies expect to deliver the shots by July 31st. And Prime Minister Boris Johnson's government is deciding whether to put more of England into a lockdown. Authorities are trying to contain a faster spreading of variant of the coronavirus. Imposing a wider lockdown would be a setback for Johnson. He just had to make a U-turn on his plan to significantly relax social distancing rules over Christmas. Israel and Prime Minister Benjamin Netanyahu are headed for their fourth election in just 2 years. The country's governing coalition collapsed after just 7 months over a budget crisis. The vote is set for March 23rd. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
Give you a sense of the real-time action. The 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off field.
It will be very interesting to watch because, of course, he's wading in essentially on the side of the Democrats and against his own party, calling for a lot more money at very short notice. After many months of this being the most difficult agreement to strike, and on the eve almost of Christmas with the December 28th deadline.
Dr. Vinja Murray of London and Chatham House, with the shock and awe of the president's speech last night, we are monitoring carefully all out of Washington to drive this story forward this morning. It will be an eventful Wednesday, no question about that. I'm not going to go over the details right now, but you can read up on it and listen to Bloomberg Radio, watch Bloomberg Television. Is really this political science exercise in America unfolds. It unfolds with futures up 6, Dow futures up 50, the VIX in a stick, 23.29 on the VIX. Other than that, it's got that quiet Wednesday before the holidays feel. Lisa?
Yeah, one thing that I'm struck by is that the unprecedented has become mundane, and I think markets have been shrugging off an increasing number of unprecedented developments. President Trump's release on Twitter, perhaps among them. And Julie Norman has been covering precedent and history and really studying it from the University College, where she is a political science professor, University College London. And Julie, I'm wondering if you could paint a picture from a historical perspective of how unusual it is for a president of the United States to come in at the last minute and threaten to put a kibosh on a deal that was struck so perilously close to the deadline with bipartisan support.
Well, Lisa, I mean, some of the words that we're hearing from Washington this morning are that Trump's weighing in is like a sonic boom. It's like a cannonball into calm waters. It's pretty much whatever explosive image you can come up with. And that is just because it's so uncommon for a president to do this at something that's so last minute, but also something that's so high stakes. This is not only a bill that will bring coronavirus relief, but also is the appropriations bill as well. And not having this go forward could result in the government shutdown within a week. So very high stakes bill. The president even surprising his own aides with his comments yesterday.
Tom Keene has been talking all morning about this person who we occasionally see on the television. He's been talking all morning about the presidential power. How much power does Trump have to come in and single-handedly stymie this deal? What's your sense of that? What's the significance of this move, Julie?
Well, it's significant in that this was such an achievement to have this bipartisan effort finally go forward after months of back and forth between both parties. And what is notable about this bill was that it passed quite strongly in both the House and the Senate passing at 92-6. And so even if Trump were to veto it, the bill itself is veto-proof. But that would take weeks longer. And again, most of the country just doesn't have weeks to wait for that relief. And again, we have this government shutdown pending as well. So so it is very significant. And again, we haven't heard from Trump exactly that he will veto it, but just that there's that potential.
And we're monitoring that right now, folks, as we go into the morning in Washington. Professor Norman, what is so important here is the idea of, okay, the president makes comments and they are domestic, his criticisms of pork, but a huge amount of it was directed at foreign aid. He's led, I believe, with comments on Cambodia. What is the level of an isolationist America that you gauge, and particularly the isolationism of President-elect Biden?
Well, Tom, to me, this is going to be a really interesting thing to watch with how Biden's team puts together their foreign policy. Even though a lot of this team came from the Obama era, they just won't be able to go back to the same globalization agenda that was typical 10 or 15 years ago. And I think we'll see a bit more of a pivot to more inward-thinking policies, still taking a much more multilateral approach, but one that is not overstressing the U.S. overseas.
You went right where I wanted to go. I mean, what do we pivot to? What are we going to pivot to what in 2021?
Well, I think that Biden will be trying to find some kind of third way in between, Trump's more populist messaging and, again, more of the globalization agenda from before. And I think that will mean still engaging strongly in terms of diplomatic efforts, in terms of working with allies and with international institutions. But in terms of just free reign with free trade agreements and some of the enthusiasm behind that we've seen in the past, a bit more attention to what that would mean for American workers, American industries, and trying to keep some focus there, rhetorically for sure, but hopefully in policy as well.
How difficult will it be for Biden to reestablish some of the ties with allies that perhaps have been frayed over the past 4 years?
Well, Lisa, it'll be a little bit of a challenge, but honestly, many other of our allies, especially European allies, are quite keen to see the Biden presidency. We're very quick to congratulate and welcome President-elect. So a lot of those ties will move forward, and especially as countries know that it's in their best interest to keep those positive relations going with this administration.
Julie Norman, thank you so much for the briefing this morning. Just an extraordinary Wednesday. Good to speak to you with UCL in London. Lisa, we frame up here with, a persistent bid, I'll say, to equities, and the VIX speaks volumes here from 31 to 23 in 2 days.
Yeah, there's no volatility, and I think that there's a question of how much there possibly could be with the backstop of both the federal government as well as the Federal Reserve. I mean, we're in a new regime of lower yields, lower returns, and yet returns still pretty good for people that are piling in.
New home sales, 10 a.m.
Yeah.
We've got
one?
Continuing claims of Michigan numbers. The only reason Diane Swank's going to be on is Michigan. She won't come on unless we do Michigan numbers, so we'll do Michigan numbers today. But really, before it, we've got Wednesday, Thursday, and Friday.
I thought it was Steve Chivarone came out. I said, when does it matter, the data? And he said, well, it might matter for the economists, but it won't matter for people in the market because they're looking longer term, and longer term things look good. So we're all very interested in knowing the data and how much pain there is out there, and we're going to talk about all those people losing their jobs and all the suffering, and markets may still go up, Tom.
If Mike McKee was here, Lisa, I know he would center in on claims. That's a Thursday statistic. We see it on Wednesday, the shock of 885,000 last week, and maybe the survey's in a little bit to 880,000, but that I guess to me, everything said and done, Lisa, is the key number this morning.
So you're going to get Vet Bill a Lego set?
No, we don't do Legos. I mean, I was being nice with Alicia, but I just never got it. You just step on them and then you throw them out. And I know the CEO of Legos is scheduled to be with us tomorrow. But.
So has Mr. Farrow been reaching out to you to taunt you about the tots, or you've been taught?
No, he's on radio silence. He is in a Tier 7 lockdown. His entourage are they're in hazmat and the whole thing.
Yeah.
I mean,
they're
locked down, and I don't know, when does Farrell return? Do we have a entry date for,
re-entry 2022?
Re-entry John Farrell?
I will say, looking at markets, he is not missing that much today. You are looking at a pretty quiet churn ahead of the vacation here that we're sitting at the end of the week. S&P futures.
We welcome all of you on Bloomberg Radio and Bloomberg Television to our simulcast, and really off of the political news in Washington, we do turn to economics. After the economic data, important analysis from Diane Swank from Grant Thornton. Stay with us. This is Bloomberg.
manage your debt. Things they didn't teach you in school, part 4. When we think of debt, we often automatically think of a horror film. But debt doesn't have to be the scariest thing in the world. If you found yourself with some debt that's stressing you out, here's how you can manage it. First, prioritize your payments and pay down the debts that are costing you the most. How do you find that out? Look at your interest rates on your monthly billing statement. If your credit card has a really high interest rate, you'll want to pay that off before paying off something like a student loan, which might have a low interest rate. The average interest rate on a credit card is 14.5%. So you're getting a good return on your money when you pay that debt off. Next, track your spending.
Merry Christmas.
Stick to a budget so you can know where you stand financially and start to save some money to pay your debts down. You can do this with apps like Digit, Acorns, and Stash. And lastly, breathe. Know that every financial mistake is fixable. You can always recover down the road, but it's best to get ahead of any mistakes that could lower your credit score. And a good credit score can save you a lot of money, earning you a lower interest rate in the future.
Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Surveillance. Good morning, everyone. Thrilled you're with us. Tom Keene and Lisa Abramowitz for the data dump of the week. Thursday, less data. Friday, no data with Christmas. But the data will roll out here, and it is a cross-section, a real snapshot of the American economy to get to Diane Swank, which we'll do in a moment. And I'm going to tell you right now, just a glance at personal income and personal spending, and then you interpolate the savings rate out of that. And those are not good numbers. We're waiting for the hugely anticipated claims numbers as well. On the deflator, Lisa, again, a little bit of an ebb there. The month over month, 0.0. The PCE deflator year over year ticks down to 1.1%. In cap goods, durable goods, yeah, they're okay. And maybe they show a little bit of manufacturing oomph, but cap goods, non-defense comes in a little light. We do get a better claims number, Lisa, from 885. We come down to 803, which is certainly a better statistic.
Okay, well, that's the better news. We are seeing fewer initial jobless claims than were expected. The expectation was for 880,000. Still, an astronomical number, Tom. We really cannot emphasize. And it really is up from what we saw just a few weeks ago. To me, the outstanding number here, not in a good way, is the personal income dropping 1.1% versus the expectation for 0.3%. Does this put the concept of lower salaries, lower income ahead for the January jobs print? And what does that say about the American labor force in a deflationary world, Tom?
That has been a hugely important issue here, the resilience of one part of the economy. Of course, I've called it the pandemic partition, and that's really what we're seeing in so many of these statistics. I want to reframe for Bloomberg Radio in this simulcast the chart of claims. It's real simple. Tattooed to your brain, 200,000, 210,000. we explode up to the millions and we come back and we're parsing here at 800,000, call it 4 times the normal claims, maybe 3.5 times the normal claims of another time in place. I've really looked forward to this because with all the distraction of Washington, we're observing to see if Mr. Trump tweets out after the bombshell announcement last night of his reticence of stimulus, all that's going on in Europe with Brexit and, of course, with France and England. You know what? Nothing matters right now across radio and TV in this American economy. Diane Swank has been following this for decades, her wonderful work at Bank One and onward, and now at Grant Thornton as their chief economist. Diane, thrilled to have you on with us today. In the slew of economic data, what matters to you?
What matters is that we're seeing that consumer spending is pulling back or slowing down at a time when we should be ramping up, and that's because of the surge in COVID cases. We've been much less of the declines, and the blow because of the surge in COVID cases has been much less than in the past. There's 3 key reasons for that I think we need to keep framed in the economy today, and that's one is mitigation measures by states have not been as severe. California, an outlier there where their cases have overwhelmed hospitals now. 2 is that we're coming off a lower base. Remember, as we look at these unemployment claims, they're still disastrous, but off of an idea that we've already had such huge losses out there. That's important to remember as well, and it mitigates the declines from here on out. I think another important issue is we've seen a shift in consumer behaviors. Not only are they less skittish than they were in the spring before we ever had lockdowns where they pulled back ahead of that, they've been actually somewhat jubilant in the response to the vaccine. We're seeing in behavioral economics a study that shows that people are actually more risk-taking because a vaccine is out there, even though that is making contagion worse. And what we really worry about now is what's going to happen in the wake of the Christmas holiday and how much travel we see and what that does to cases through the worst of the winter, which are supposed to crest in January. So that's a really important thing, is that we still have momentum, but we are losing momentum at a critical time, and we have to 2 steps back before we get forward again and unleash this pent-up demand.
We're not out of the woods, that is for sure. Just to bring you some more numbers as they roll out, we're getting revised initial jobless claims for last week. That is revised upward. That is not good. Up is bad. To 892,000 from the 885,000 that were initially reported. That does taint a little bit the better than expected initial jobless claims of 803,000 this week. I will say, Diane, to your point about personal income and personal spending, the decline, the bigger than expected decline that we saw in this week's data, to me stands out even more than the initial jobless claims. Is this being driven by support programs running off and people not getting as much unemployment aid, or is this because people with higher wage jobs are getting laid off in greater numbers?
Well, actually, it's interesting because we saw a major slowdown in employment gains in the month of November. It slowed to a near crawl. That's important, and what little we did get tended to be lower wage employment gains. We have seen a slowdown in hiring of higher wage jobs, which had done much better up until we got into October and November. So I think that's important as well. We also know from the high frequency data that we saw a sharp deceleration in spending in the second half of November, which included that week of Thanksgiving. And the deceleration, although we saw declines by low wage and middle wage household in that number, the biggest deceleration, although it was still positive in the number, was by high wage households. And we know from earlier in the crisis that the behavior of high wage households really matters. Not only did their incomes and adding of those jobs slow down quite dramatically in the month of November, but we also saw their behavior change, and that has ripple effects for middle and low wage jobs. We know in New York, for instance, in the highest wage areas where the highest income was, as consumers pulled back on their spending, it meant layoffs in many service sector jobs in those high wage areas. So that's what we're watching, is this sort of domino effect you tend to get, and that's what we're worried about going forward.
Well, Diane, it's the heritage of your Michigan economics, which is a good study of history of economics, and so much of that is wage flatness and even outright wage deflation, whether nominal or real. How close are we to this great, great fear of some form of wage deflation?
I think we're still not to wage deflation, although it is notable, and I wouldn't be surprised to see as we look into some of the data that in the height of the crisis, many firms in the spring saw this as a temporary event, and as a temporary event actually did temporary wage cuts, which is something we never saw before, even in high-income households. And I wouldn't be surprised as we see, we saw many economies abroad shut down and go into lockdown much more aggressively on their contagion measures than in the U.S., that there is some of that behavior as well. I think we're still not into a wage deflation scenario, but it really underscores the PCE numbers ticking down a bit as well, that the fears that people had of this being an inflationary supply chain surge, which is not showing up, I think is important, that this is more of a disinflationary event, not deflationary, but disinflationary, and that's what the Fed's worried about.
I've got thank you. I've got 8 ways to go here, folks. This conversation is so important. But Diana, I'm just going to partition right over to the gross question, as Olivier Blanchard has provided leadership on. There has to be an overt policy to reflate. Do we have an overt policy to reflate?
Not yet, not unless we get a lot more fiscal stimulus. This fiscal stimulus that we're talking about now, we have to see, stimulus is the wrong word, relief, although there is some things in there that are for transit, mass transit that keeps people going to low-wage jobs, and for schools, which I think is very important, but really important not in that relief bill, which has yet to be signed. I think it's very important to point out there's not the state and local spending that we need, the transfers to the states, and that means as we unleash pent-up demand, we're not going to really be able to fully recoup all the employment losses we lost, because state and local governments will still be cutting. Also important is, after we get through that initial surge in economic activity, is the idea that we have to not only recoup what we lost and get back to the previous peak in economic activity, which was the fourth quarter of 2019. We don't expect to hit that until the second half, if we're lucky, with herd immunity, of 2021. That's 2 years lost in economic activity. But also, remember, we also lost what would have been absent COVID, and we were generating about 200,000 jobs a month. By February, that will be another 2.4 million in the hole on job gains that didn't happen because of this crisis.
There's an article in Bloomberg Businessweek, the headline, "It's been a great year for stocks and a bear market for humans." We get these numbers, they are dire. Markets do nothing. They are up tremendously over the past couple of months. Does that worry you?
It does worry me, but I do think there is a fundamental break between what's happening on Wall Street and what's happening on Main Street. Wall Street is long technology and the sectors of the economy that have benefited the most from this perverse environment. The S&P 500 only accounts for about 20% of employment in the U.S., is hardly reflective of the U.S. economy and less reflective than it ever has been. At one point in time, the Dow Jones accounted for about 50% of employment in the U.S. economy. That just isn't the case anymore. While Main Street is long discretionary services and low-wage jobs. And what we're seeing is the persistence of the losses of those low-wage jobs, a slowdown in hiring of high-wage jobs, and that's leaving Main Street at a different place than Wall Street.
We could go all morning. We can't. Diane Swonk, thank you so much, with Grant Thornton off of a wall of economic data. The data did not move the markets, not so much bond markets. Futures up 9, Dow futures up 68. But as Ms. Swonk said there, Lisa, it's real simple. The idea of inflation evident, it's not there.
Yeah, personal income. This to me is the number of the moment, going down 1.1% versus the expected decline of 0.3%. People getting less money in the door, and this is leading to less spending, also in the data, than people had expected.
So your good observation, and I would go in further, and we've got the tables coming out here right now. I'm trying to scroll down. McKee does this better than me. I mean, Lisa, I'm going down in flames here.
He's watching this and really enjoying it, by the way.
McKee's at home just going, oh, my word, he's so lame. The savings rate is 16%. Last time around, it was 26%. We're not back to normal. To me, Lisa, a real gauge of spending income dynamics with all of this government distortion is when the savings rate gets back to where it's supposed to be, which is 4, 5, 7%, saying we're just not back there yet. We are still highly not normal.
But it's getting down there. And at what point is there no more gas left in the tank?
I would get back, yes, I would admit that as well. I'm trying to find disposable income to make us all smarter, including me, but Tom Keene, you are no Michael McKee. Coming up, the head of the FDA, conversation this morning, Dr. Hahn. This is Bloomberg on radio, on television.
With the First Word News, I'm Rishka Gupta. Now President Trump is signaling he might not even sign that massive coronavirus and spending bill passed by Congress. Last night, the president called the bill a disgrace and said it's filled with wasteful and unnecessary items. He demanded that Congress increase the stimulus checks going to most Americans from $600 to $2,000. President Trump's trade czar is leaving next month, hailing the tariffs that his critics hate. Robert Lighthizer rejects the consensus from economists that the duties on imports from China and steel from around the world have been a failure. He says that in 5 of the 6 quarters before the pandemic, there was a decrease in the U.S. trade deficit. Plus, Lighthizer says the tariffs helped lead to higher household income. A post-Brexit trade deal hangs in the balance, with fishing rights still the key issue. Prime Minister Boris Johnson and European Commission President Ursula von der Leyen have intervened. They're making a last-ditch bid to reach an agreement before the UK leaves the single market at the end of the year. And Volkswagen CEO Herbert Diess warns that cash-rich tech giants pose a bigger challenge to the German car maker than traditional rivals like Toyota. Diess was reacting to a report that Apple is developing a self-driving car. He says that the practically unlimited access to resources instills a lot of respect. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishka Gupta. This is Bloomberg.
Thrilled to have you with us as well. Futures up 10, Dow futures up 66, and the VIX 23.36. Joining us right now, really for a conversation of the day, is Mr. Hahn, Dr. Hahn of the FDA. To be very direct here, when you are a radiologist and an oncologist at MD Anderson, when you walk in the room, people should be silent and listen. Dr. Hahn, we are honored to have you with us. Is Washington listening to you and your FDA?
Well, good morning. Yes, absolutely. I think particularly around the vaccine, we have been getting the message out that our terrific career scientists have been looking critically at all the data and made a decision based upon the science and data. And we're very confident about the safety and efficacy of these vaccines.
Dr. Stephen Hahn, it comes down to a confidence and a trust, and it's one thing to see the president-elect out being shot. Have you had the vaccine yet, sir?
I have not, and that's not because of any lack of trust. I'm waiting for my turn based upon risk factors. I do actually have adult children, one child who's received it, and so that should tell you a lot about my confidence in it, that's for sure.
Where do we need to get to with the vaccines? Are you and the FDA more focused on a broad set of vaccines, or are you focused on the millions required to get to that hurdle rate that is magical?
So we're focused on both because it's really important. So we need to get to the point where we have herd immunity in the United States, frankly, around the world, to stop the spread of this virus. And experts think that's 70 to 80% of the population vaccinated or have had the disease. So there's a multi-pronged approach. One is working with the developers of the vaccines still in development to help get them through the development process, through the clinical trials, and then an application to us, at which point we will review the full data package. And then also making sure that we're working with the manufacturers of the 2 authorized vaccines to make sure there's as much ramp up as possible. And that includes providing information about the supply chain, also making sure that there's a high quality of manufacturing, which we believe there is.
Commissioner, how do you combat accusations of political interference in the very medical deliberations of the FDA?
So our response is to be transparent. As you know, in June and then in October, we issued guidance around the vaccines. And we've done this we've issued more guidance this year than in that period of time than I think we ever have. And the reason for that is we wanted everyone out there who is developing medical products to know what our thinking was. What would we need to see in order to do an authorization for any medical product? Now, particularly for vaccines, we put those guidances out so that the manufacturers would know what information to send to us in an application. We stuck to that guidance, we followed that guidance, and we had unprecedented transparency around our review process with an open public discussion of the data. No other regulatory agency in the world has done that. I think that provided great confidence to the American people.
Dr. Hahn, we look at Silver Spring, Maryland, and the set of buildings that you have out there and the heritage back to how America didn't do thalidomide like so many others. And you've dovetailed it over your career, Dr. Fauci's career, who folks will be with Bloomberg later, the good people at CDC as well. Are you confident we can get our science back into the system?
Oh, I'm 100% confident. It's been such a privilege to work with our scientists. I have come in my career as an oncologist to depend upon the FDA. I know that my colleagues in medicine do as well. What I can tell you is that every decision that we made has been based upon the existing scientists. We've had to be pragmatic. We've had to make decisions based upon limited data sets, but we've always updated them as more data came in, and we will continue to do that. And our decisions are made by career scientists at the FDA.
I want you to address for those listening and watching right now, Dr. Hahn, the shock of anaphylactic shock or something of that variance. Walk through the statistics you have learned about what we see in the modern media. We go up to Alaska, wherever, and someone is shocked by the giving of the vaccine. Put that in the proper science perspective.
Yeah, really important. This is such a great question, and it's. I'll put my doctor hat on because when you talk to someone about a side effect, if it's uncommon or not, you put it in plain language. So the way I would describe this is the clinical trial data from the vaccines did not show a serious risk of anaphylaxis, that most serious side effect. But if there is a side effect that's 1 in a million, let's just use that as an example, or 1 in 500,000, that's you're less likely to have anaphylaxis than you are to get into trouble walking across the street in a crowded road. And so it's a very low frequency event. If it does occur, we're monitoring these very closely. And as you scale up vaccination and you vaccinate millions of people, you might see a very uncommon event. It's why people have to be observed. It's why we have to have the protection there should an allergic event occur. We believe it's a very uncommon event. We're still looking into some of these events that have been reported. We take them very seriously, and we'll continue to provide that information to the American people.
Dr. Hahn, we learned in February and March the dynamics of a horrific virus. It's a three-form differential equation, folks. All you need to know is there's a lot of moving parts. I want you to go back to Rice University and the math that you did years ago on when we can say all clear, based on the complex moving parts of multiple vaccines, booster shots, and the thirst to get the vaccine of America. When can you say within a window we will be all clear?
So, I learned a long time ago as a cancer doctor, I don't have a crystal ball. My sincerest hope that in 2021 we will achieve herd immunity and we can put this pandemic behind us.
That was way too short a question there. I think Dr. Hahn really didn't want to talk about that, but you got out nicely to 2021. Johnson & Johnson, I believe, has a distinction of some form of vaccine without a booster shot. Partition vaccines with a booster shot and those without. One-shot efficacy.
So this is all based upon the development process. And in the development process, you move from developing the vaccine with a platform to animals to humans. And it's during that development process that a developer would figure out, do you need 1 shot or 2 shots to get the sort of immunity that you think would protect people? So as it's publicly known, J&J has a vaccine that's 1 shot, not 2. If that passes through the development process and we see great efficacy and safety, that would be a really terrific event for us. We have to see what the clinical trial data, though, show to determine whether it's safe and effective.
I believe the countable statistic, Dr. Hahn, is 4 offspring. I think that's what you've generated here in a wonderful marriage over X number of years. How will the Hahns handle the Christmas social life of a family as Prime Minister Johnson and, frankly, President Trump are focused on? How do the Hahns do the holiday season?
Well, we socially distant. We normally have a big gathering, 20, 25 people. We're not doing that this year. Immediate family. If we do have non-immediate family in the area, we're going to socially distance and wear masks. But we're going to keep it very, very limited this year. And there'll be other Christmases. What's really important is to protect the most vulnerable and to prevent community spread. We all have a responsibility there.
One final question, Dr. Hahn. Of course, the news at Pfizer in some form of many millions of new vaccines for America. When do we say fully vaccinated or at least mostly vaccinated for the elderly, the true aged, and also for the essential workers in our hospitals?
So the CDC and the ACIP committee has labeled this 1A, 1B, 1C, and 1A and 1B fits for most of those folks that you're talking about. And I believe the schedule at this point is that we can get almost all of those people vaccinated by the first quarter, so by the end of March, maybe sooner. And so we're working really hard at FDA with hand in hand with CDC to try to get as many vaccines out there as possible and work with the manufacturers to ramp up manufacturing.
Thank you so much, Dr. Hahn. Greatly appreciated today. Stephen Hahn of the FDA and the commissioner here, as they've had a hugely successful week rolling out the vaccine. We're going to do what we've done at Bloomberg. This was a decision made, a command order essentially, to do science at Bloomberg. David Weston will drive forward the conversation today with Dr. Fauci, someone you're more than familiar with. To have Dr. Hahn and Dr. Fauci with us back-to-back here in a number of hours is really quite a joy for all of Bloomberg today. The further joy in the markets off that wall of economic data is futures up 12, Dow futures up 82. That's a lift to where we were a few hours ago, putting us right at the 30,000 level on the Dow and just beneath 3,700 on the S&P 500. I want to draw your attention to what we're going to accomplish here over the next number of days. What we're really waiting on right now is less the data and less the finance, but 3 stories which I think which I think are quite important. Certainly to hear from the president after the bombshell that was given last night. Our Kevin Cirilli is on top of this story, along with all of our Washington News Bureau. I have not seen the president tweet. Natalie, help me here. I don't think we've seen presidential tweets here in the last 10 minutes, but we're monitoring that very, very closely. And, of course, to hear from Secretary Mnuchin would be important as well. I can't emphasize enough how closely kept this video seems to have been within the Trump administration. The other story we're following off of stimulus and the battle forward is in the United Kingdom, and we've barely covered this, I'm sorry, this morning. There's been a major change where France will allow movement of goods between Dover and between Calais and Dunkirk. And we've had some video through the day of the anticipation that we would see the symbolism of a fair amount of those agricultural goods moving forward. And then the one thing we haven't talked about, John from the United Kingdom emails in and says, Tom, you've got to talk about Brexit. So I need to leave you with a discussion on Bloomberg Radio and Bloomberg Television on Brexit. The Brexit conversation is exactly the same as it was a week ago, a month ago, a year ago. They're moving forward, and I think they're having more meetings, and it has a lot to do with fish, which are stuck at the Dover port as well. We will continue forward important conversations, particularly on stimulus. Stay with us. This is Bloomberg.
新型にはなんと2万点以上前進でついてます。なので2万点あることにより、その情報が取れない、平面がないんですね。なので全てをスキャンすることができるので。どちらにせよ自分のサイズを1回最初から、適正なものを発見してそれを買って、家に届いてきたらぴったり非常にハッピーというのがやっぱりしかるべき姿かなと思ってます。
The trends, investments, and competition of the European ETF industry. Join us on Bloomberg ETF IQ Europe.
For our viewers worldwide, I'm Lisa Abramowitz in for Jonathan Farrow. The countdown to the open starts right now. We begin with the big issue, a $900 billion relief package stuck in limbo.
I am asking Congress to amend this bill and increase the ridiculously low $600 to $2,000 or $4,000 for a couple. I'm also asking Congress to immediately get rid of the wasteful and unnecessary items.
The president signaling he may not sign the pandemic relief bill, with President-elect Biden already calling on Congress to resume fiscal talks in the new year.
Unemployment's extended for another 10 weeks. It's going to take a lot longer than that. But Congress did its job this week. And I can and I must ask them to do it again next year.
This is mixed economic data, and disappointing incomes put stimulus checks in the spotlight.
The truth of the matter is the economy was slowing.
Economic data are weakening quite significantly.
Some softening, isn't that surprising.
No question, things looking really weak, both for the labor market and for consumer spending near term.
We will see further softening in December.
We're going to go through a rough patch. The real worry is that now, this package, it's large, it's $900 billion, but it's not large enough.
This is a much needed bill.
We do need a bridge for the next 2 or 3 months.
Once the vaccine arrives, put on your seatbelt. I think this economy could really rip.
I'm not predicting, rainbows and sunshine and unicorns.
You have to look through kind of the near-term weakness.
Where you start to see real adoption of the vaccine.
The light is shining a lot brighter, but ironically, the journey there has gotten darker.
That's when you're going to start to see the bottoming of the economic data.
For more, here's Bloomberg's Kaylee Lyons. Kaylee.
Well, Lisa, the disappointing data from this morning, that weak data really came on the personal income and spending front. Personal income falling 1.1% in the month of November. That is a massive decline relative to just the 0.3% that economists were looking for. Actually, it was worse than all but one of the 64 estimates in a Bloomberg survey. Now, personal spending missed too, not by as much. It fell 0.4% versus the estimate of a 0.2% decline. So the spending figure is not as disappointing, but both reads definitely were the weak spot in the data this morning. Some downward revisions for October as well. And another thing to point out in those spending figures, spending on services fell for the first time since April. So as you said, Lisa, it really underscores how those stimulus checks could help feed this recovery if indeed the president does sign that bill and those checks go out. Now, not as weak this morning was the initial jobless claims numbers. Those claims actually fell to 803,000 versus the estimate of 880,000. So it ends that streak of higher than expected jobless claims that we've been seeing. But I would point out that the highest number of claims came from California and Illinois, both states that have had more restrictive lockdown measures put into place to tamp down on the virus. And that 803,000 number, Lisa, still is very high relative to history. As for some of the other data, PCE came right in line, that core print coming in at 1.4%. That was the estimate. And durable goods helped as well, up 0.9%. The estimate was for only a 0.6% uptick, so better there. But when you remove transportation from the equation, it was a slight miss. I would end by saying here, Lisa, not a whole lot of market reaction to any of the data this morning, but it is 2 days out from Christmas. Volume, liquidity are light, but that doesn't mean the market isn't waiting and watching to see what's going to come out of Washington, Lisa.
Kaylee Lyons, thank you so much for that. Tal Buckins, Michael Purvis expecting robust animal spirits to fuel risk appetite in 2021, writing, quote, "The scarcity of investable assets means dips will continue to be bought. Risk asset valuations will be supported at unusually high levels." Michael joining us now. Michael, let's start with the economic data we got out today. It showed a decline in personal spending for the first time since April. This is bad news. The market doesn't care. Does any economic information matter at this point to you?
Well, it always matters. I think the question is time frame here. And right now we have a lot of animal spirits surging into year end, and that'll probably spill over into January. But look, I think there's whether you look at put call ratios or put call skew in the options market, whether you look at the AAII bull bear indicators, there's a lot of one-sided sentiment here. And I do expect, as constructive as I am on markets in the broader term, I do expect there'll be a hangover of sorts to process this overextension, sometime later this winter. No question here. I think specifically with respect to the economic data, look, it's a year of high noise to signal ratio here. So you have to give the markets an out, not to get too overly excited about, one given print here. One thing I would also just mention on this, the durable goods and the cap goods prints we just got, which were slight misses here. It's important to recognize that a lot of the inflation story we've seen over the last 6 to 9 months has really been driven by the durable goods here. I personally expect as we get further into 2021 that will be more transitory, and all that. So I don't know if this particular print is really an omen of anything to come, but I do expect that surge we've seen in durable goods, and you see it in commodities inflation, ultimately to be, sort of a temporary, over a few quarters, not a few years type dynamic.
Let's unpack some of this, partly what you were saying with respect to the over-exuberance that you expect to cool off a little bit later in the winter, maybe in the next couple of months. And I'm wondering what could possibly drive that, given the fact that we got overnight President Trump coming out saying that he might put the kibosh on this $900 billion stimulus plan that's baked into markets, given the fact that we've got a deteriorating economy, and given the fact that there still are obstacles to overcome with respect to the vaccine. When is it a dip that's enough to buy if the dips are bought before they even can become dips?
Yeah, no, I know it's tricky here. Right now we have this, this trifecta of monetary stimulus, expected fiscal stimulus, and vaccine stimulus, all sort of converging here, and that will cool off at some point, and you'll probably get a nice 5-10% correction in equities, and the VIX, jumping higher, and bond yields coming lower. There right now, I think that the momentum is your friend right now. I heard you discussing earlier this morning, Lisa, about this sort of head fake about the Trump tweet last night and how the futures have sort of powered through that. I think just a couple of things here. One of which is that, look, we've been waiting for this package since it was supposed to come in September. Right. The markets were able to plow through it then. And I think, there are, of course, forward looking. But there's another dimension here too, a sort of second derivative, if you will, which is that this may support sort of what I would call a delayed and lighter blue wave in January 5th here. I was just noticing that like the predicted odds for the Democratic control of the Senate have ticked up this morning.
Interesting.
There's still, it's a lot to move further before we actually get a blue wave here. But if Trump's tweet and his actions here help the Dems there, that may mean a bigger fiscal stimulus down the road than had he not tweeted here. If it does, in fact, sway the elections, because I think it does create a little bit of confusion for some of the Republican dynamics in Georgia right now.
By the way, you were being kind, Michael, in saying that you heard my discussion. You heard Tom Keene ragging on me for assuming that markets would sell off and getting that call very wrong. So thank you for being so diplomatic there. There is a question if people do get a little bit more risk off, and there is this hope to try to just preserve capital rather than actually reach for extra yield. What is safe at this moment when people are predicting an uptick in inflation, albeit muted? Where are the new safe havens?
Yeah, I mean, I think this is one of these interesting things that has emerged from 2020, which is that safe havens are increasingly viewed sort of on a relative basis. We always think of safe havens as absolutes, right? When things go bad, you kind of rush there, right? But rushing to treasuries right now at the rates there are so low. Rushing to $1, for example, when there's a sort of big structural factors that have been exacerbated by policy responses and some of the other factors in 2020, those are less obvious here. So for example, in March during the volatility, utilities, which is a normal sort of like risk off equity allocation play, they did horribly because they were overvalued coming into it, right? And so I think when you think about safe havens, whether you're talking about the dollar, you're talking about gold, you're talking about within equity complex, utilities versus big cap tech, it's all about, it's really much more of a relative game than it used to be. I think we've lost some of those absolutes. So, right now, look, treasuries are certainly more attractive, in the 90 BIP level than at the 50 BIP level that they were, 9 months ago there. So they will certainly provide more hedging opportunity. But if they get bid down, if the yields get bid down to 65 or 70 bips, you may want to be looking elsewhere, maybe gold and so forth, or the FX factor, maybe it's more yen than jumping on the dollar. So I think that's one of these weird things that's been evolving, and I think it's going to continue to define the risk-off moves in 2021. It's getting your safe havens right.
Michael Purvis, thank you so much for being with us, and have a wonderful holiday. Bloomberg's Abigail Doolittle joining us now with a look at the stocks moving ahead of the opening bell. Abigail?
Well, Lisa, it's hard to talk about stock movers and not mention Tesla because, of course, this week the stock is now on pace for its third down day in a row, the first time we will have seen that since mid-November after being included in the S&P 500, a massive run up into that event. Now some sell the news action, plus Apple, of course, the announcement this week, or the news that the company is strongly thinking about getting into the electric vehicle market and perhaps producing vehicles by 2024, even 2025, perhaps because of the pandemic and influence there. And then Nikola, the electric truck company, those shares down sharply, down 9.4%. A garbage truck pact has been broken. The development will take too long, the cost too high. Those investors not liking that. As for the vaccine makers, it's pretty interesting because we've had some sell the news action here over the last 2 weeks. Pfizer actually right now on pace for its first up day in several, the second up day in 11 days. This on the news that the U.S., they've reached a deal for another 100 million doses. That brings the total to 200 million. That's the same for Moderna. All these stocks, though, Lisa, down sharply over the last 2 weeks. Moderna actually down 25% over the last 10 days. So again, sell the news action for these vaccine makers as the vaccine is getting into the world. Is that a broader signal? We'll have to see.
Thank you so much, Abigail Doolittle. Coming up, the Fed buying is set to slow in 2021, leaving investors to absorb a $1.8 trillion bond glut. That conversation up next, talking about whether yields could potentially rise with Matt Miskin of John Hancock. In the markets, as we've been talking about, we've got a risk-on feel, slightly elevated with equities near their session highs, about 19 minutes here ahead of the open, and bond yields really constrained here within a range. Up next, Matt Miskin. This is Bloomberg.
a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
What we think the Fed will be looking at is not just the level of long end yields or the shape of the curve, but what is driving rates higher? What's driving any type of steepening of the curve? If the Fed sees signs that it's an unhealthy rate rise, a rate rise driven by too much Treasury supply or a policy error or something along those lines, the Fed will fight against that. That's when we think that they could extend their weighted average maturity, or that's when we think that they could increase the pace.
Bank of America's Mark Cabana expecting the Fed to pick up the pace of its buying in the event of a debt deluge. JP Morgan seeing a $1.8 trillion bond glut in 2021, with the long end of the curve poised for a tug of war between Fed demand and Treasury supply. For more, Bloomberg's Kaylee Lyons. Kaylee.
Lisa, it is all about supply and demand. But before we look ahead to what could happen in 2021, let's remind ourselves of what we've seen in the Treasury market in 2020. On December 31st, 2019, the 10-year yield sat at 1.91%. Today, about 51 or so weeks later, it's at 0.93%. We are talking a move of roughly 100 basis points over the course of this year. Of course, we haven't breached the 1% threshold since March, and that puts Treasuries on pace for their highest return since back in 2011. We have to keep in mind that this happened even as the Treasury issued a boatload of debt that would have pushed yields higher if not for the Fed's asset purchase program swooping in and absorbing all that debt. Things could change in 2021, though. What we were just looking at there is JP Morgan's estimate. Investors could have to absorb $1.8 trillion worth of debt as the Treasury shifts its issuance toward the longer end, and the Fed looks to buy less government debt on the secondary market. That is way more than what happened this year. Of course, this year we actually saw net issuance falling negative $441 billion. Now, that is a dynamic that could, in theory, lead to higher yields, Lisa, which could end the streak of 7 years of positive total returns for Treasuries. And that could happen even if the Fed does decide to extend the average maturity in its asset purchase program, because, again, investors are still going to have to buy a record amount of long-term debt. The Treasury said in November it planned to shift financing away from bills. That could result in a higher average maturity. Wells Fargo Securities saying it expects the weighted average maturity, it should rebound back to around 70 months, where, of course, it had hovered since 2015. Until this year, Lisa.
Kaylee, thank you so much. A lot of bond managers are not that concerned about the potential for a long-term bond sell-off. Matt Miskin of John Hancock expecting that reflation narrative and trade to lose steam, writing, quote, if the reflation narrative fades, fixed income positioning will be better in the intermediate part of the curve, and only a mild credit bias would be warranted. Matt, joining us now, why are you not concerned about that $1.8 trillion glut of net treasuries coming to market as JP Morgan laid out?
Well, first, let's start with the amount of negative yielding debt outstanding here, Lisa. And if you look at that, I mean, we're talking 17 to 18 trillion dollars now of negative yielding debt. You look at Greek bonds or some of the peripheral countries in Europe, Italy, trading at much lower yields than the United States. So in the U.S., we're almost like a high yield bond in a global context of the developed world. We believe crossover buyers will emerge into 2021, and we still have the remnants of a pandemic going into next year. I know all the positive news around the vaccine, the distribution, and that's good, but this is not going to be a normal first half of a given year. It's going to be tough, and we think actually demand for bonds will remain pretty strong, at least in the first half at a minimum into the next year.
It's almost as if this economic data that we keep getting actually does mean something, right? I mean, and maybe the bonds are responding to it. You talk about foreign money coming into the United States, this idea of the high-yielding bond, and yet we've got a dollar that's weakening, which is one reason why people think that yields can rise. Can you square that dynamic for us?
Yeah, I mean, you think about the dollar, it's been in a much of a downtrend that we saw in the 2017 to 2018 period. Looking almost a mirror image, and you look at the euro as well, it's been kind of playing out in a similar way, and it's really a synchronized global growth environment off the low, China-driven, pull through in demand is what we're seeing. But if you remember in that 2017 to 2018 period, 2018 first quarter is in essence where the dollar found some footing, put in a low, not that much lower than where we are today on the DXY, and then actually moved higher. And we are looking at the parallels of 2017 to 2018 of a global synchronized rebound to a multi-speed world, and one that is actually going to be a bit more constrained next year after pulling through a lot of great returns in financial assets and pretty decent economic growth, all things considered, to close out this year.
So I'm looking right now at negative real yields, and this goes to this question that was sort of embedded in your comments earlier, this idea that yields will remain muted and this reflation narrative has perhaps gotten a little ahead of its skis. Do you think that yields would be where they were without Fed intervention? In other words, that the Fed is not doing that much to actually suppress yields, it's just the economy?
I think it's, you can't discount the Fed completely because the forward guidance and the QE, the balance sheet is significant. I mean, if you started this year and you said the Fed's going to increase their balance sheet by $3 trillion, it's, you'd have to say that yields would be lower than where they started. But the economic data as of late, I think, is anchoring yields. You're seeing real-time economic data roll over. Bloomberg has some of the best alternative data, and it's globally, it's whether it's mobility, other real-time data is really contracting. And I think that's providing an anchor. I think there's this reflation trade or positioning is sticky. You're seeing, and I listen to the comments of everybody that's come on this morning to the shows, and it's all the same story basically of reflation, take more risk, move on, and I think that's what's keeping this stickiness. But I think as the calendar year turns, some of that bid, some of that constant bid in those parts of the markets will actually fade. And you might actually see a lower 10-year going into the first half, which I don't think is what many are seeing right now across in market participants.
Yeah, indeed. And I will say thank you for a slew of shameless plugs there. I do wonder, though, what is the low? What's the floor here that you could see on 10-year yields heading into the first quarter, given the fact that people do expect yields to creep up?
I think around 60 to 70 basis points has been kind of that equilibrium that we saw over the summer months and really what has much of the post-pandemic or amidst the pandemic world. 50 basis points has been the low. But I go back to this negative yielding debt phenomenon. And it's almost like there's a black hole developing out there in the world, whether it's the ECB, Bank of Japan, just keeping yields so low and so much negative yielding bonds that, you got to be happy with a positive income stream right now. I know it's not great relative to an inflation on a real basis, but hey, a positive yielding bond is going to be something to appreciate in the beginning of the year. I think 50 basis points is probably the low. But after a big move up like this, that's not bad for some duration and roll down in the intermediate part of the curve.
Matt, just 30 seconds here. I'm wondering whether you would go against the call to go into riskier and riskier risk and credit.
Yes, absolutely. We're focusing more on higher quality. High yield to us looks rich right now. You got to keep your bonds acting like bonds, not just equity risk. Keep the volatility of the portfolio down right now. Be patient. And that's how we play the beginning of 2021.
Matt Miskin with a somewhat contrarian call. Thank you so much for being with us. Coming up, the analyst action you need to know. That's next in our morning calls. And later, an IPO frenzy, raising a record $435 billion in stock sales. That conversation still ahead with Mark Lehman of JMP Securities. In the markets, we do have risk on. People are going for it ahead of what is likely to be a year of stimulus. Yet another one. The S&P now up 0.3%, 7 minutes to the open. The FTSE 100 also up with still some concerns about Brexit. From New York, in for Jonathan Farrow, I'm Lisa Abramowitz, and this is Bloomberg.
COVID-19 pandemic has hit the U.S. economy hard.
But the damage has not been evenly distributed.
Now comes the challenge to rebuild more equitably. Join us for a Bloomberg special report, The Unequal Recovery, on Bloomberg Television.
I'm Lisa Abramowitz in for Jonathan Farrow. This is the countdown to the open. Time now for our morning calls. We'll look at some of the analyst recommendations on Wall Street this morning. First up, Wells Fargo raising its price target on shares of Disney to $201 from $182, reiterating its overweight rating. The analyst citing strength in the company's video streaming initiatives. Next up, BMO downgrading IAC Interactive to market perform from outperform and cutting its price target from $166 to $175. The analyst citing valuation concerns following the stock's recent advance. Shares up more than 50% since November. And finally, Credit Suisse raising its Honeywell price target to $225 from $182 and keeping an outperform rating. The upgrade following Honeywell's recent acquisition of Smart Systems. The analyst saying he expects software M&A to act as digital multipliers across the enterprise. Coming up, following a record-breaking year for IPOs, we're looking at what's in store for 2021 with JMP Securities' Mark Lehman. The opening bell up next, and this is Bloomberg.
Chinese brands now account for 7 of the country's top 10 cosmetics lines, up from just 3 in 2017. That has pushed out foreign brands like L'Oreal's Maybelline, which has seen its share of China's makeup market plunge by half since 2010. For more, we're joined by Bloomberg editor Bruce Einhorn. Bruce, why the drop?
Chinese brands are becoming much more adept at reaching Chinese consumers, especially now at a time when more consumers are reluctant to go shopping outside. People are spending more time at home. People are spending more time on social media. Chinese brands are very good at using social media, using live streaming, using other things in order to market. Chinese brands also tend to be less expensive. And so at a time when the economy is struggling a bit, there's a lot of uncertainty, people are more budget conscious, Chinese brands have a bit more of an advantage.
How have you changed as a leader since that day in 1993 when you joined Roche?
You develop over time, and it's a series of experiences which hopefully make you a better leader.
Their CPG history, their experience, and really how we might be able to combine together to really create this fantastic public company. And so we kind of got into the SPAC thing a little bit before it became such a hot method of going public.
Give you a sense of the real-time action, the 10-year yield tumbling now 11 basis points, so continuing in this knee-jerk risk-off feel. Welcome back to Bloomberg The Open. We now do have equities on the brink of gains following a surprise Twitter post by President Trump last night where he came out and he said maybe he would veto this $900 billion stimulus effort. Equities do not care. There it is, bell open. S&P up 0.3%. The NASDAQ just barely eking out a gain, basically flat in the day. But interestingly, the Russell 2000 outperforming, up 0.6% or more, actually, rising into the open here as people take a look at the reflation trade and shrug off any near-term volatility. If you flip up the screens, you can see that you are getting a bit of a sell-off in bonds with yields a bit higher at 94.46. If you look at the yield, 0.94%. And then the dollar getting a little bit more weakness with the euro gaining 121.96 and crude generally getting a lift. Let's head over to the markets desk. Bloomberg's Abigail Doolittle joining us now. Bloomberg.
Well, Lisa, we do have green on the screen for the major averages, but we have to look at Tesla because, as we were mentioning earlier, down for a third day in a row. The first time we've seen that since the middle of November. This, of course, sell the news action on being added to the S&P 500. We are, in fact, looking at this stock down 9% over the last 3 days, the worst stretch since the end of September, plus the potential for competition from Apple equals Tesla down. Now, Nikola, the electric truck company, this stock is down even more on the day itself, down about 9% after a garbage truck deal is off with a partner. It is seen as the development taking too long, cost too high. So we have some weakness for those electric vehicle makers. As for Qualcomm, though, the chip stock popping slightly higher on a price target raise at Baird. That firm is positive on Qualcomm's 5G possibilities. And then Paychex put up a strong quarter, beating top and bottom line. They also raised the fiscal year estimates. However, let's also once again review the vaccine makers because we have a little bit of a mixed bag here. And this is so interesting because talk about sell the news. Moderna now down more than 25% over the last 11 days. This, of course, as these vaccines are getting into the real world. Pfizer, however, breaking its lagging streak, up about 0.5%. Let's see if it can hang on to those gains. This as it has doubled its dosing order with the U.S. But overall, again, sell the news action for these vaccine makers, Lisa. It's going to be interesting to see if there's broader implications around that.
Yeah, Abigail, thank you so much. The biggest IPOs, meanwhile, delivering some of the best returns in 2020. Investors looking beyond pandemic-fueled uncertainties to set a record-breaking year for new offerings. NICE CEO Stacey Cunningham weighing in on the changing ways companies are coming to market.
What we're seeing is more innovation in the capital markets than we've seen in the past 2 decades. So it's right now the power is companies are getting to choose the way they go public, partially because they've stayed private so long, they're much bigger. Their goals for going public are less about capital raising and more about the other benefits that the public markets provide, like liquidity and currency and that visibility and scalability.
I remember once upon a time when Jay Clayton of the SEC was talking about the death of public equity markets. Bloomberg's Taylor Riggs joining us now with more. Taylor.
Not quite this year, at least not in terms of the death, but you did see, of course, SPACs, direct listings, all wrapped in with some of those traditional IPOs as well. And why not, right? Equity prices are at record highs, so come to market, take advantage of those record highs, those valuations, and you saw it this year, Lisa. Huge year for IPOs, 351 this year, worth more than $100 million. Total value, $151 billion. That is just this year alone. But if you flip up the board, it wasn't necessarily IPOs or direct listings. It was the year of the SPAC attack. Average SPAC IPOs raised about $334 million. That is 45% larger than last year. And SPACs made up 52% of the total U.S. IPO market this year. So even though last year we were talking about direct listings as a threat, I'm not sure anyone was ready for the SPAC attack and the year, at least that was, with some of the other ways in which companies can go public. Finally, though, Lisa, it all comes down to performance. Take a look at this. IPOs this year up 120%. We have a SPAC ETF as well that is also up close to that number as well, and both outperforming the NASDAQ and the S&P 500, only up about 35 to 30% this year. So if you are in that IPO index, the performance is there as well.
Just amazing, Taylor. You got the supply, but you also have clearly a ton and even more of demand. Meanwhile, Mark Lehman of JPMP Securities seeing his 2020 call for a hot IPO market come to life, to say the least, but expecting a lot of, quote, wannabes in the 2021 pipeline. Mark joining us now. What does that mean, Mark? What are wannabes?
Well, like you said, we had predicted a hot tape back in the middle of 2020. There's a lot of great companies that now have access to public markets. I think there's going to be some FOMO for some people who missed, or at least they feel like they missed the IPO window, which I don't believe they have. But I think see the valuations, They see the kind of participation from mutual funds and pension funds and others. And I think there's going to be that kind of early 2021. We're going to see a similar event, which we'll see some SPACs come to market. We'll also see some back-end SPACs actually buy the companies that would have gone public via IPO. So that is almost another IPO for these SPACs because they got to buy the companies, as you know, and create new shareholders. So that's another liquidity event, another opportunity to create new public companies. I see a lot of that in 2021.
So SPACs, special purpose acquisition companies, they basically raise a pool of cash and they're companies that are managed by respected fund managers. And then they say, when we find a company that we think is worthy, we'll go out. You guys can vote on it, whether you want to stay in this, and we'll go buy it at a fixed price. Is this a good deal? Because traditionally, these have not necessarily outperformed the market.
Well, it's hard to make broad generalizations, and I always say value is in the eye of the beholder. So some of these have been extraordinary public companies already. Look at DraftKings back in the spring, which back March, April, people said, well, there's no sports, so there's nothing to gamble upon. And yet some people had some real vision and put some money in that. That SPAC obviously was trading around $10, is up 5x from there. So it's like anything else. You got to be very careful about what you're participating in, do your homework. But there's some extraordinary values in some extraordinary companies. You look at one you just talked about, Nikola, had a lot of hype. They were going to change, revolutionize, I guess, garbage truck. I didn't know about the garbage truck market. I heard about the truck market.
It's wild, Mark. It's wild.
Exactly. That stock went from 10 to 80, and it's about to get closer to 10 than 80 right now. So, you know, it's caveat emptor. I think these are big decisions portfolio managers are making, but there's lots of great companies. You started the program by saying that this has just been the year of the IPO and there's 200-300 IPOs. That's accurate. But back 20 years ago, 25 years ago, when Wall Street was very busy, there were many, many more IPOs than that. So this is just a different, the death of the IPO has been greatly exaggerated, but I think the equity capital markets are the best place to find value, the best place to find innovation, and that's not going to change. As it didn't change this year, it's not going to change next year.
20 years ago, though, Mark, companies had fewer options in terms of where they raised money. I mean, they've spent the past 10 years raising billions and billions of dollars in private debt markets, and so they've already become more established before they go public. How much of that value, of that dynamism, has already been taken out of them by the time they go to the public market?
Well, it's a great question, and I'll use an example of a company, another go-around from one of the great value creators on Wall Street, Tom Siebel. Tom Siebel's company, C3, went public this month. C3, one of the great innovative companies in AI, at a very hefty multi-billion-dollar valuation. And they have been a big success on Wall Street already as an IPO. We'll see how they execute over the next few years. We're very confident they will. But you look almost 30 years ago at his first iteration, that was Siebel Systems. Siebel Systems went public. I believe they raised in the low $20 million, and they had, I'm kind of guessing, $10 to $15 million of trailing revenues. Same guy, two great companies. Think about that. That's exactly what you're talking about. So in the interim, and they probably had a couple $100 million market cap when Siebel came out. So yes, companies are staying private longer. There's more ways for them to access that. But if they really want access to the capital and real broad-based shareholder base, as well as getting liquidity for their employees, which a lot of them want. Because remember, as a competitive advantage, they're recruiting engineers and they need to get liquidity for some of these people. It's just different, and innovation never dies. And yes, innovation in companies as well as innovation in the equity capital markets, and that's what's happening. So there are more ways to raise capital, but the public markets are likely to give you the best valuation over time. And I think that's what people are showing. Look at Snowflake, which is a wonderful company that we helped take public earlier this year. Multi-billion-dollar valuation. A lot of people complained about, boy, that had that first day pop, and boy, you missed it, and everything went to the people. Well, guess what? It doubled since the first pop, okay? So, you know, well, and you can laugh about that.
No,
that's what's
in appreciation.
Okay?
In appreciation,
yes, no, exactly.
And I will say,
but I mean that
you've gotten
I get that.
No, you've gotten it right, and you've actually nailed the call. And IPOs have done very well, and a lot of these companies are going to be even more valuable down the line. You do talk about Nikola, for example, which is going to be closer to the $10 than the $80 a share. And I'm wondering what proportion of the IPOs you see in that category, perhaps not fulfilling the promise at a time when people are increasingly investing in indexes of IPOs or indexes of SPACs or what have you.
Well, listen, I think the index phenomena is here to stay, and I think active managers obviously have to do a better job of beating those indexes and making sure that when people look at their 3, 5, and 10-year records, they're doing that and buying the best companies. And you're seeing some portfolio managers who do beat the indexes over time, and good for them. And that's really what should happen. I think you got to be really careful lumping everything together. There's been some unbelievably impressive winners, even out of the chute. From the 2019 class of IPOs. We were on this show a year ago talking about how hyper-valued DocuSign is, how hyper-valued Zoom Video is, how overvalued Peloton is. And I get the dynamic of COVID. But again, that's part of the calculus, which is there was some small chance that this kind of economy that we're in currently was going to happen. And I assume some portfolio managers played the play-at-home stocks like Peloton and Zoom, not because they thought COVID would hit, but because that was going to be a trend that's not going to change, okay? Yeah. Just like AI is a trend that's not going to change. What's happening, I've been saying it, so we'll talk about some of the people who have not completely participated. We took a company called Vroom public earlier this year. It was a great pop on the first day. It's come back a little bit. But what I've been telling everybody is, whether it's Vroom or Carvana or somebody else, my son and daughters are not going to go into an auto dealer like I did and buy a used car. They're not. They're not going to get their auto insurance by calling their neighborhood agent. They're not, okay? They're not going to walk into a bank and open up a checking account. Bad parenting on my part. They don't know how to write a check. They know how to Venmo, and they know to do some other things. But those realities of that generation, those generations are true, okay? So you got to figure out how to play those things, just like the innovation in life sciences. We created a vaccine in a year, 2 vaccines in a year. There's more coming. Yeah. That nobody would have guessed, okay? That kind of innovation in life sciences is actually here to stay, okay? So finding the kind of companies and the weightings, and I'm hearing this from portfolio managers, they're taking weightings away from energy and other stuff to put it in life sciences because that kind of innovation is actually accelerating.
Mark Lehman.
That's where people should play.
Thank you so much for being with us, Mark Lehman, and congratulations. In all honesty, you have gotten it right, and I hope that the optimism that you have is with us, in particular with respect to the innovation on the biopharmaceutical areas to get us out of this pandemic. Let's head back to the markets desk. Abigail Doolittle joining us with more. Abigail.
Well, Lisa, we've been looking a lot at those electric vehicle makers on the decline, but what we do have on the day, in contrast, renewable energy gaining in a big way. In fact, fuel cell, Plug Power, these companies are all trading higher on the possibility that there could be some stimulus for them within that package. If it's not vetoed, you see, take a look at that, fuel cell up 12%. SunPower at this point, and actually Plug Power going mixed, but nonetheless, big gains over the last 2 months. Now, that does not just, it's not just renewable energy, because if we take a look at traditional energy, the reflation trade is on, some optimism back in the market, Lisa. We have the likes of Chevron and Exxon both higher as oil is higher, and then take a look at JP Morgan, Bank of America getting a lift as yields rise ever so slightly, enough to help out, again, the reflation trade. A little bit of a reprieve, perhaps the S&P 500 heading toward its first up day in 4.
Indeed. Abigail Doolittle, thank you. Victor Koslov, SVP Global, seeing opportunities in some of the riskiest debt, distressed debt soaring to almost $1 trillion with bankruptcies testing levels not seen in a decade. A harsh reality for commercial real estate is $430 billion in debt is set to come due. Right now, just want to give you some breaking news. We do have Brexit negotiators drawing close to a UK-EU trade agreement. For more, this is Bloomberg.
We have some good news in terms of vaccines and a chance to overcome the health crisis, but we are not there yet.
We need the fiscal stimulus, and we need it relatively quickly, because I can see where the second wave's coming. You can see consumer spending beginning to get impacted again.
What we need surveillance to be stronger. We need public health measures, because you have no other way at the beginning. This is your best weapon, and you need to use it well.
The good news is that both the vaccines and the therapeutics, in particular the antibodies, are coming along and will start to bring that number way down.
We don't just need more investment in public health. We must also rethink how we value health.
I do believe a targeted fiscal stimulus is going to be in order to really begin a more equalized economy.
Our generation's biggest problem.
Climate change is happening.
And the world's most innovative solutions.
Transport, industry, buildings, electricity, all of those things.
Everything you need to know about our changing environment, the politics of global warming.
We can and we will deal with climate change.
In the fight against climate change, Bloomberg Green has you covered.
Look at the high yield default rate. The high yield default rate for 2020 is going to be about 10%. 10% is the highest default rate over the last 10 years. Over the last 10 years, it's been 3.5%, right? So right there, that tells you it's one of the biggest distressed opportunities in the last 10, 12 years.
Victor Koslev's SVP Global seeing opportunities in some of the riskiest debt. Distressed debt soaring to almost $1 trillion with bankruptcies testing levels not seen in a decade. A harsh reality for commercial real estate as $430 billion in debt is set to mature next year, forcing lenders and borrowers to come to terms with what the outlook looks like for a sector beaten up and transformed by the pandemic. For more, let's bring in Bloomberg's Taylor Riggs. Taylor.
And Lisa, part of the concern is that we haven't really seen the worst of it yet. Like you said, about $430 billion in debt coming due next year. And you just think about the office space, the gyms, the retail space that are all sitting empty right now. And that is the problem going into next year. You have CBRE saying that property values won't even bottom out until next year. And you're already seeing some of the delinquency rates rising for hotels, for retail real estate. And so that is part of the problem. Here you're looking at a chart of the Fed's balance sheet. This gives the Fed all reasons to worry. For the reasons I just laid out. They, of course, have added an additional $3 trillion alone this year to their balance sheet, bringing the total assets on the Fed's balance sheet, $7.4 trillion. That is well above the $2 trillion in total assets back in 2008, when the Fed had added an additional $1 trillion to their balance sheet in that year alone. Finally, though, if you flip out the board, I mean, really, this just comes down to prices, Lisa. As you can see, CBRE, some of the real estate advisory companies, they're managing to hang in there pretty well. But the actual office space REITs like Vornado, think Boston Properties, those are not doing well. As you can see, they haven't even recovered really since March alone. You played that sort of Victor Kosla yesterday. He was just one of two distressed investors yesterday telling us on the closing bell, default rates are up and the recovery rates on those defaults lower than they've ever been.
Taylor Riggs, thank you so much. JP Morgan's David Leibovitz joining us now. Let's start there, David. You've been looking at this reflation trade. You've been looking at going against the pain that we've seen this year. Would you move into some of these distressed real estate sectors, particularly in the bigger cities, focused on offices and hotels?
So I think that, I would agree with a lot of what was just said. And I think that there is an emerging opportunity for distressed investors. When we think about what happened earlier this year with the Fed, you basically had a 2-week window where you could put money to work in a distressed way. And then they came in and papered over all of the cracks with obviously abundant amounts of liquidity. So when we think about the way things are going to play out over the course of 2021 and into 2022, I think that you will see opportunities, particularly in real estate. The office sector is a really interesting one, mostly because I think a lot of people have prematurely perhaps called for the death of offices, but we firmly expect to be back at the office here at some point in the next year. And so I think it's going to be about finding those businesses that can truly function in a remote fashion, and taking advantage and putting those off to one side, and then recognizing those businesses that have seen a temporary disruption, but are going to need to have their people in a single space at some point down the road. I'd make the point that for a lot of services businesses, the most valuable capital they have is their human capital, and that's arguably best generated through in-person interaction. And so I don't think that we can completely throw the office sector out. I do think that there are going to be some opportunities here going forward.
So as we talk about the opportunities and the return to some sort of normalcy, how do you play this reflation bet? I mean, how do you find those areas that haven't already been identified as we have this massive search for yield and everybody and their mother seems to be going after the same thing?
So I think that's where it gets a little bit tricky. And one of the things that I've been saying to clients over the past few weeks is it feels like everybody's kind of singing from the same song sheet as it comes to the outlook for 2021. You know, everybody likes cyclicality, people like international, so on and so forth. And so, you know, to me, the real area of opportunity, it's a bit of a gray area, but you want to find those businesses, again, that have seen a temporary disruption to their business model, not permanent demand destruction. And I think that, you know, the financial sector is a really interesting spot in the equity market, obviously coming back here over the past few days, given the Fed's announcement around buybacks. But, you know, if policymakers can effectively build this bridge to the other side of the pandemic and defaults and credit losses aren't as severe as what a lot of people are expecting, you know, I think that there's real opportunity there. And on top of it, you're getting yields which are well above what you're able to find in the high quality bond market. And so it's about finding those names where the baby has kind of been thrown out with the bathwater, but, you know, arguably they will come back as the economy normalizes over the coming 12 months.
Is that financials call independent of what yields may do?
So I think that it is. You know, there's a lot of obsession with, you know, the level of rates and what that means for financial institutions. You know, look, we just spent 10 years in a very low rate environment, and banks have figured out how to make money. Now, I do think you want to gravitate to the names with more diversified revenue streams. I think traditional banking may very well be under pressure in a low rate environment, but actually our work shows that it's more about the shape of the curve and the change in the steepness of the curve that really tends to lend itself to bank profitability. I think that just looking at the level of rates, you know, while still important, is a little bit of a shallow way to think about that sector.
Just real quick, David, what's your biggest contrarian call?
So I think that, you know, obviously the financial names, it was a big contrarian call, but as they've come back here over the past few days, I think it's becoming less so. You know, where we really see opportunity is in some of these beaten down, consumer-oriented entertainment names. I think that as the economy revs back up next year, there's going to be a lot of pent-up demand to go out and experience things. And people are going to be experiencing things in very different ways than they have historically. And so it's about finding those companies that have taken advantage of the pandemic environment to really develop their digital infrastructure and digital channels for delivering content. Yeah. But they complement that with, again, those in-person experiences, which, as we've seen over the past 12 months, you know, are something that people really want to get back to as the economy comes back online.
Especially if you have young children at home. David Leibovitz, thank you so much for taking the time. Coming up, the market-moving events that you need to be watching. That's next in our trading diary. In the markets, a bit of a rally despite the bombshell that some people talked about, with President Trump tweeting after 7 p.m. last night that he was not going to necessarily sign this $900 billion fiscal support bill. We've got yields a little bit higher here. The NASDAQ actually down, but the S&P up nearly 0.5%. Meanwhile, if we flip up the board, you can see a classic risk-on feel with oil getting a bid. We have, of course, copper getting a bid, and we have yields a little bit higher. 10-year yields now up now 0.9596%. Coming up, we've got the trading diary. This is Bloomberg.
Substantial further progress means what it says. We'll be looking for an inflation to be substantially closer to our 2% longer run goal before we start making adjustments to our purchases.
That's a long time to be very accommodative, but that's basically the horizon.
They can buy more bonds and they can buy longer maturity bonds, and that would put more downward pressure on long-term interest rates.
Time now for the Trading Diary, what you need to be watching this week. At the top of the hour, we get University of Michigan consumer sentiment and new home sales data. President-elect Joe Biden announcing another member of his cabinet at 11:15 a.m. President Donald Trump heading to Mar-a-Lago for the holiday weekend this afternoon. And finally, for 2020, on Thursday, U.S. markets closing early for Christmas Eve. 26 minutes into the session, taking a look at markets, we are seeing a rally on the riskier on-earth segments of the market. You can see the NASDAQ taking a little bit of a dip as that has become the haven trade and tends to sag when everybody wants to take risk. You can see it's been led by what we see over in Europe as people reassess the risk from the new strain of the coronavirus. This was the countdown to the open. This is Bloomberg Television.
This is Bloomberg Best, your weekly review of the most important business news, analysis, and interviews from Bloomberg Television around the world.
Ken Burns.